European equity markets then just 20 seconds or so away from the start of our trading day. The European futures picture guide looked pretty uninspiring. US futures likewise. We're waiting for CPI tomorrow.
Absolutely. That appears to be the main event. I think we're in a holding pattern as the kind of top-down story dominates. We're up by 0.5% yesterday on the Stock 600. We are now opening up here in Europe this morning. Are we going to see a clear kind of sense of direction? I very much doubt it in terms of where we're going to see the strength coming from. LVMH is down a touch. I think, again, I'm just waiting to see if I've got confirmation of that opening. Yeah, it looks like it's down by around 0.6%. Interesting on a day when we're talking about the aviation sector. We're going to be talking about Airbus and Boeing, but we're also talking about defence. Interesting to see Safran weakening up a little bit. But I'm waiting. BP's starting off nicely.
Okay. That's a little bit of upside there. Just looking at the sector breakdown, real estate, the worst performing sector, and we've talked about this a couple of times through the programme, how the narrative around real estate is really interesting to watch, because if you look at the sort of in-the-moment talk around where rates go and dialing back rate cut expectations, that might make you a little more gloomy on real estate, and it's the worst performing sector today.
The worst performing sector year to date as well, I think.
Right, okay, important to note. But then if you focus on where we've come over the last 6 months, maybe you tell a story of rates having peaked, and that seems to be what some in the market are telling. So interesting one to watch. Autos and parts then retreating from some of its gains yesterday. That sector down around a couple of tenths of a percent this morning, but most sectors in the red, it would seem.
I want to double check my facts on the year to date on what exactly has been happening with real estate. Second worst performing sector, utilities have been the worst performing sector. I think we got a price on Atos. I just want to double check this. I think we're up by around 5-6%. That's not as much as we were originally anticipating.
Yeah, out the gates, we've got a flash across the terminal says it was up 8% out of the gates. But yes, it's maybe some volatility settling down a little bit. But yeah, this is a business that's been trying to reduce its debt pile, now up by 7%, trying to reduce its debt pile. It's come out with a plan to do that, and you were drawing our attention to the sort of short-term cash and credit line requirements and the longer-term story around investment here.
I think the longer-term story is basically they need to do a big sort of debt for equity swap, which is kind of looks like it's a big part of the plan. Where the cash comes from in the more medium term, I think is an open question. Short term, it looks like they've shored up the balance sheet in order to get them through to this larger refunding program. But it'll be interesting to see exactly kind of how ultimately this gets resolved and how big a part the French government ultimately is going to have to play. So at the moment, it looks like we've got a fairly cautious equity market open, actually driven by some of the stock stories we've been watching. BP up by 1%. The trading story, once again, looks like it's going to be the sort of the salvation of that story. Okay,
so that one is having an impact. That's the energy sector then, up by 0.2% this morning. Basic resources, the best performing sector, up by 0.4%. And as so often when you see that, you go to what's happening in mining, in the actual underlying commodities, and iron ore up by 3.7% overnight. So that's kind of explains that one.
Rio Tinto up by 1% this morning. So where do we go from here is the big question. Everybody's trying to work out kind of once we get our noses beyond what the CPI number looks like, where equities are going to go globally. Joining us now to try and answer that question is Sebastian Redler. He is the head of European Equity Strategy at Bank of America Global Research. Good to see you.
Good morning. I like the new look.
The glasses. So new studio.
They're on and off.
Yeah, they're on and off. New studio. Also quite a long way away.
Strong.
Can't see old. Well, yeah, they are quite strong, yeah. You're still quite cautious. You and I have been talking for a long time now, and you've been consistently cautious as this equity rally has continued to ramp up. You're drawing kind of historical parallels with 2007. Give us the kind of the base case about where your head is right now in terms of kind of where equities go from here.
Yeah, I think we've all been surprised by the economic resilience, especially in the US. And the historical playbook that we are aware of, that the investors are aware of, is very clear. You hike rates, initially nothing happens, then everybody has to refinance, you start firing workers, and the economy goes south. And so the key question that we're really asking is this time going to be different? Because the playbook is so clear, all the warning signals are there, the yield curve is inverted, unemployment is very low, you have to digest these rate hikes, and we're holding our breath and saying, is the macro weakness coming? It's not coming for now, therefore the market is strong. But the question is it been cancelled or just delayed?
And the answer to that question is?
We think it's just delayed. We think
By how much?
We think it will be here by Q3. So the historical lags would suggest you should start to see weakness now, which you don't, but you should see the peak impact by Q3, and it's still an open question of whether it's going to come through. But the market is pricing zero risks. You've got credit spreads at 300 basis points, consistent with a 0% default rate, and the market is basically saying it's all over, everything is fine. We're a little bit more cautious.
Okay, and this takes us to 2007 and parallels there, doesn't it, Sebastian? And I don't want to freak everybody out too much, because you're not saying that the size of the impact is going to be like 2008, 2009. We're not talking about that. But what you are drawing parallels with is a benign risk premium compression, and we shouldn't misunderstand that as kind of everything's okay. And you're referencing their corporate spreads, which seem pretty benign. But you don't think that tells the full story?
So if I give you a retelling of 2007, and you will immediately recognize the current episode in that, people knew there was a macro risk. They were starting to bet against it, fairly certain that it would come through. Betting against the U.S. housing market for 2 years. Everybody lost their shirts because spreads just went tighter. People were marveling why the economy was holding up, why the market was holding up. Then everybody threw in the towel, and there was the famous quote of the time, they had to keep dancing until the music stops. Risk premium were very low. In May 2007, they were at a 10-year low. But then the economy rolled over, the labor market cracked, the default started to come through. Everything that you were worried about materialized, and the fact that in between risk premium were very tight, as they are now, was no guarantee.
So the lack of parallel, I suppose, is that we're not thinking about the housing market quite so much this time around. What we're thinking about is corporate profits, and people who think that the music will keep playing and people will keep dancing, they say, look at those corporate profits. Actually, they support the levels that we're trading at right now, and AI will only mean that continues to happen.
Absolutely, and I would turn it around and say, this is like 2007. Profit margins were at peak levels, profitability was very high, as it always is at the peak of the cycle when the labor market is very tight. The question is, in 2007, monetary tightening came through with a lag and basically forced the labor market to roll over. Is it going to be different this time around?
The Fed wants the party to carry on, though, doesn't it? This is the thing. The Fed has no interest in letting this party stop. The famous quote is that the central banks are there to take the punch bowl away so that the party doesn't get out of hand. And it looks like central banks are going to try and do that. So why will the situation roll over when the Fed's talking about 2-3 rate cuts this year? The ECB is probably going to deliver something similar. They want the party to carry on.
Absolutely. And I would say it's very important, the point that Anna made. They have important disanalogies with 2007. So you don't have the same vulnerabilities. Credit quality is better. Balance sheet quality is better. But the underlying dynamics and mechanics we think are the same. And then you talk about central banks. The Fed started cutting in August 2007. And the recession started only in December 2007. And the reason for this is monetary policy works with a lag of around 1.5 years. So if you've tightened a lot and then you cut a little, it's not enough typically to...
But the Fed feels like it's not cutting... These aren't recessionary cuts. They're, I want to keep the party going cuts.
Absolutely. But if everything you do in monetary policy historically has worked with a 1.5-year lag and still does, and that's the question, is this time going to be different? If you cut now, it benefits the economy 1.5 years down the line. But of course, that's not what we're talking about. We want to know what happens in 3 months' time and in 6 months' time.
Okay, and so what does that do to stocks then? If you're right, and that's what the parallels with 2007 are there, but they're incomplete. What does that do for stocks? What does that mean for stocks?
So when we went to the US about a month ago, everybody was confused, and people were not happy about this rally. They were rather slightly unbalanced by the rally, but nobody had expected it. And they were wondering, what is the dominant theme here? Is it the AI revolution? Is it the pickup in the global macro cycle? Is it the central bank easing? And what we are saying is the dominating theme that connects all the different moving parts is that risk premia are so low. You were talking earlier before I came on. Capital goods are at the peak. Utilities, as you said, worst performing sector. So what explains this is that they're both highly correlated to credit spreads. Utilities roll over and die effectively if credit spreads tighten. Capital goods soar. So what happens in the scenario we describe is credit spreads are going to widen to reflect some of these risks. That means lower asset prices because it basically means a higher cost of equity, but it also means underperformance of cyclicals versus defenses as the sectors that have benefited from the compression get hammered, and the ones that have been pushed down basically see the light again.
We've talked a lot about real estate, and how does that tie in to what you're seeing there? Because it seems like it's a sector that clearly, as Guy's been saying, obviously driven by the rate story, and yet
absolutely.
What are you seeing on that side?
So we have a small overweight in real estate, partly because it has performed so dreadfully over the last 2 years, but it is more ambiguous in terms of the signal. For capital goods and utilities, it's absolutely crystal clear what they do in this scenario. For real estate, it's more complicated. They would benefit from the lower rates. If the labor market cracks, if the Fed has to cut, then real estate benefits. But they also are very sensitive to wider risk premium because they are so sensitive to all-in financing costs. So if your risk-free rate goes down, that's great. But if your risk premium goes up, that's not so great. And it really then depends on the relative size of these moves, but it's a more ambiguous narrative.
What I hear from a lot of US investors, and I've been to get your take on what you heard in the States, was that they're now looking elsewhere around the world for the catch-up trade.
Absolutely.
In the short term, I hear what you're saying about the more medium term, but tactically short term...
That's such a great question,
Is this the catch-up trade?
So I would say what is always... If you have an unemployment rate in the US below 4%, you are clearly late cycle. And what is always a key feature of a late cycle is you've got competing narratives that are still all viable, and you don't quite know which one is going to finally be dominant. And so I completely agree with you. Even if that's where we're going, in the near term, some other narrative might be salient. And so you'd say, if this is like 1995, which is another comparison we make in the note, i.e. this was just a mid-cycle slowdown, now the global cycle is inflecting, then you say the US is still running at 3%. You're not going to accelerate, but Europe is in recession, it has negative growth. So if there's no recession globally, Europe can recover, and potentially that is where you would have some upside, but you would really have to make sure that the labor market doesn't crack and it's not 2007, and that you're really in this 95 scenario.
Where do you see the cracks then in the story that take us to these cuts by the fourth quarter? I think you said by the fourth quarter we get there.
Third quarter.
Third quarter, sorry. And, the damage is done, I suppose, from your argument in terms of higher interest rates. But we still got to see the impact of that.
Absolutely.
Where do you see
we basically see three types of evidence. So first I have to admit, it is a very complex situation, and there are a lot of data points that speak against what we're saying. So, for instance, the labor market report on Friday was enormously strong, and we have to acknowledge that. But we would make three types of argument. A, historically, what has led to these breaks is basically an inverted yield curve, a lot of monetary tightening has to be digested, and very little spare capacity in the system. Check, check, check. That's all there. Then what do we see in current data flow? 70% of employment in the US is from small to medium-sized companies. Ironically, one day before the labor market report, we got the NFIB, which is the survey of small to medium-sized companies, a collapse in hiring intentions consistent with the unemployment rising to 6%. The small to medium-sized companies are saying, we are now feeling the heat from higher rates that pressures our margins. We have to protect the margins. How do you do it? Lower variable costs, get rid of workers.
But they're still struggling to find the people they need, which I think is interesting.
I think because you have a tight labor market. It's levels versus rate of change. You have a tight labor market, but the willingness and the appetite to hire, and this is a very reliable survey, they're telling us we no longer want to hire as we get this kind of margin pressure.
I love these conversations. They're all about fundamentals. They're all about kind of how the market should... Does this market feel like it's a fundamentally driven market at the moment? Because it in so many ways doesn't. It feels like a speculative market. It feels like fundamentals and the kind of the mechanics and the maths that we've all been taught to do doesn't apply.
So, of course, I'm bearish, and it's always very easy when you're bearish to say, oh, this is all irrational. I think the market is justified where it is. Given the state of the economy right now, what we're debating is, will it be so brilliant and so impressive? So why is the current level of the market justified? Maybe you've got some pockets of overshoots, for instance, in capital goods or construction materials in Europe, very hard to justify. But generally what you've seen is productivity growth in the US at a 50-year low in 2022. It's now at 2.5%. The historical average is 1.5%. Whenever you get an increase in productivity growth that the market says is sustainable because of AI, the equity risk premium gets compressed. Equity risk premium is at a 20-year low. Most of our clients have never seen such an equity risk premium over their career.
But if we haven't seen AI deliver what some people say it can deliver, like Jamie Dimon talking about the steam engine yesterday, then does the music just keep playing? Do we just Keep going higher.
And that's basically, that brings in our third analogy with 2000. In 2000, it did not just rise productivity growth to 2.5, it went to 4%. And remember, famously at that point, the equity risk premium turned negative, and everybody was like, wow, stocks are safer than bonds. If productivity growth is sustained and high enough, then the equity risk premium will continue rising. And so the key question is, from here, will you see this upsurge in productivity growth because AI gets adopted far faster than any other technology in human history, or does the labor market break? In that case, that happened in 2000, productivity immediately slumps cyclically. And so all these narratives are still in the play, and we are saying the most reliable signal is monetary policy is enormously powerful, works with a lag. We haven't seen the full impact yet.
Feels like big stakes.
Yeah, big stakes. I have to say I enjoyed 1995 much more than I did. So the kind of the passing message is what? Buy bonds, sell equities?
If you can approach it from different angles. My main message is, you want to be very positive on equities when risk premium are high and can be compressed. You're currently at a 20-year low on the equity risk premium and close to an all-time low on higher credit spreads. Good risk management suggests taking chips off the table. Watch the labor market. If this narrative comes through, downside for equities, upside for bonds, upside for defensives, downside for financials and cyclicals.
Sebastian, great to see you. Always such a pleasure. Genuinely enjoy a conversation around the fundamentals of these markets and the mechanics of them. I'm going to put my glasses back on again. Apparently a strong look. Sebastian Redler, Head of European Equity Strategy at Bank of America Global Research. Thank you very much indeed. Let's look at the core European stocks we always watch at this time of day just to get a kind of scorecard on what is happening. As you can see, very kind of tight ranges this morning. These stocks are not moving much. Ferrari's a little soft, which is interesting as well. But we've also got some weakness in LVMH. Some of the luxury names certainly giving back some ground. But I still think this is a kind of top-down market today. I don't think there's much of a signal. There are some single stocks that are worth watching. Atos, interestingly enough, this morning has now turned negative, which I think is an interesting kind of tell on what is happening here. Maybe the kind of debt to equity swap beginning to weigh. In terms of the other stocks that we're watching, BP, trading looking good, Anna. That certainly has been a narrative that has driven this company. This is a company that doesn't trade on US multiples, but kicks out an awful lot of cash right now, outperforming the energy sector this morning.
And then we're on to a couple of stocks that are on the move as a result of some upgrades and downgrades. So let's get to Renault first. In the auto space, Renault raised to overweight at Barclays, a price target of €60. That's a fair chunk above the 50 or so we trade at this time. And a lot of people focused on what they've managed to do, overtaking Nissan in that shake-up of the long alliance, of course. That's been where the news has been made in recent times. Let's get to Yara. This is a fertilizer business. We don't talk about this all that often. But Sparebank, he's upgrading this one. Sorry, no, cutting this one. Cutting it to neutral at Sparebank to 375 krona, which is actually above where it trades right now. But anyway, that stock down by 4.4% right now.
I just wanted to have a look at the Yara share price. One of the things we learned at the beginning of the Ukrainian war was just how kind of correlated the chemical sector, the fertilizer sector, is to what has been happening with gas prices. What I think is interesting is that this is a company that has come down really quite sharply over the last year. So it was trading at the beginning of the year 460, we're now trading in the kind of 330s. Gas, the sector in aggregate has been a story that has been driven by lower gas prices, which are very low at the moment. I think they were negative in Texas the other day.
Yeah, absolutely. So we'll keep that one in focus. Atos very much in focus. I think that one's halted now. So such has been the excitement around that one. It gained as much as 8% at the start of trade. And we've heard from the business, of course, they're seeking 1.2 billion euros in equity and debt for their rescue plan. We'll get further details on this story. We'll go to Paris for you and get an update on Atos shortly. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with? Upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
And for Atos, just to get the company going.
Yeah, so there's the cash it needs, there's the credit line, there's the longer-term story. Benoit, remind us how this situation quickly gets political and why it gets political, because this, I understand, is a business, a tech business, that has connections and supplies key parts of the German, German universe, the French political universe, or even the French military universe?
Yeah, also German, actually. So it got a deal with Siemens a few years ago. But yeah, it's really key to the French army, for example. It does IT for the army. It does supercomputers that are key to the nuclear industry and thus the defense industry. It's also doing the IT for the Olympics happening this summer in Paris. So that's a key company. And the French government is providing 50 million of funding, together with the 450 million of fresh funding. That's really the emergency fund to keep the company running. And the French government is getting a golden share through this investment in the supercomputers business. So they will have a say if when the plan goes along, there is possibilities that it gets in non-French hands. The French government will be in some way able to block that.
Okay, so that's where the French government sits. Talk me through how creditors are likely to react to that. What options are there now on the table? Are there other options that creditors are considering? Is there potentially still some spin-offs that could happen here? Just walk me through kind of what other options exist right now for this business.
So Atos is sort of saying that the debt situation is too bad for any big M&A plan to happen now. They tried to sell part of the business before to Czech billionaire Daniel Kretinsky, to Airbus as well for the strategic part. It sort of failed, so that is on hold, although it could always come back in the picture. What's happening now is really the plan A, negotiate with the creditors, have them make proposals. But there are also other investors trying to invest. The first shareholder is a smaller French IT company called OnePoint, and they got support from Butler Industries, a fund, a restructuring fund here in France too. So they are trying to line up financing and to come up with their own plan. That could merge with the Atos main plan that was designed with the mediator. So the goal is really to make it all merge for Atos. But you could always see new interest. We reported that Daniel Kretinsky could make a new bid for the business if he was asked to inject money or to do anything to help the company. So all that will be very much of interest in the coming weeks.
Okay, Benoit, thanks so much for the update. Bloomberg's Benoit Berthelot with the latest on this business. Yeah, it will be fascinating to see whether we get, what role Butler Industries will play, what role that key shareholder, whether Kretinsky comes back with any further interest. So not the end of the story when it comes to Atos.
Can I just flag something? Dollar yen. Keep an eye on it. So as we've been kind of working our way through this morning, it has been creeping higher and higher and higher. We've just had a touch 151, just 51 above 151.90. We're now trading at 151.90. The market is kind of pushing. You were making the point earlier. Does the BOJ maybe have to go a little early in front of the CPI number? The market's kind of taking us right up to the wire.
Well, maybe the market's making the same assumption that you made at the top of the program. Of course, you wait for the, or thinking the BOJ is making that assumption. Of course, you wait for CPI. You see how that falls. Maybe because there's a chance it does some of the work for you. So you see if you really need to intervene. But the market may be thinking, let's test you beforehand.
Yeah, well, certainly they have been testing it, and the market action this morning certainly is taking us right up to the wire. We'll talk about this story a little bit more. We'll be discussing the Japanese currency, 34-year low for dollar yen. When and how does the BOJ step in, and what kind of short covering rally, as Anna talked about earlier, could we ultimately see on the back of that? We'll discuss that next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. and across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. And, you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal.
That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Tuesday the 9th, there's actually some interesting things happening this morning which I think are worth paying attention to, and they are being folded into what is happening with the European equity story this morning, Anna. So iron ore is having a really strong run this morning. Out in Singapore, it's been up by nearly 4%. That is translating into some strong performance that we're seeing out of the European mining stocks this morning, so that's interesting. But broadly, yields are a little lower this morning. Again, I think it's kind of the yin and the yang of the equity market and the bond markets. Everybody's kind of just waiting. Yields were a little lower yesterday, they're a little higher today. Equities higher yesterday, a little lower this morning.
Yes, we've had a couple of days where the yield story has been very much in focus. It hasn't necessarily weighed too much on equity market thinking. It seems that equity market investors not too preoccupied by whether it's 3 or 2 rate cuts we get from the Feds. You know, if we end up getting none, well, that'd be a different question, of course. But stocks remaining resilient, but actually also just keenly waiting for that important data point today, which is that CPI print.
Is that something that drives us through 4.5 on a US 10-year? I think is a key question that everybody's asking. If we get through 4.5, do we get to kind of 4.51? Does that take us up to 4.7? Then you start to get quite big ripple effects into other asset classes, and you're already starting to see that in the currency market.
Yeah, absolutely. We're watching the yen very closely. We are on the dollar yen at 151.90 on the nose, and we are for the second time, I think, in the past 24 hours, hearing from the finance minister over in Japan, saying some of the things that we've heard many times. So this is Suzuki saying they're watching FX developments with a high sense of urgency. Sometimes that's code for absolutely nothing, but sometimes it tells you that something is coming.
Get ready, folks. Get ready. You push this one too far, we're going to take some action. But when does that action come?
Yeah, absolutely. So let's get into that conversation. Bloomberg's Aline Oyamada joins us now to give us thoughts on what the yen is up to and where it goes. So the yen hovering, Alina, near a 34-year low. It's seen as at a critical level. Do you expect BOJ intervention? Does the market show signs of expecting BOJ intervention?
Yeah, like Guy said, the market is ready for intervention. That has been the talk for the past days or weeks. And like you said, we are at the very close level, that 152 level that markets have decided that is when the authorities could step in. We are already at a weaker level than last time they intervened, so it all points to an imminent act. But like you all know, the BOJ likes to surprise, so it's always hard to see what the timing would be. Some people are now saying that they will wait for the US CPI because that could trigger some big moves and even end up doing some of their work. So yeah, we are on standing by for that.
How is the market positioned into this? We were talking about this earlier. There's an awful lot of short dollar yen short yen positions in there.
Yeah.
How extreme is positioning? So therefore, how big a reaction could we get once maybe that intervention starts to kick in?
So the market is super short. Long story, it's super short. Everyone is bearish on the yen. So that means if we do get intervention, we could see a very quick rebound and a very sharp one. But ultimately, I would say it all depends on combined policy action. So not just currency intervention, but also more rate hikes. And that's the other big question, what they will do next.
How tie this into the CPI print then? Because we're getting this US inflation data coming out. And do you think then it is something they wait for to see how the market moves?
Yes, definitely. The US inflation print is the biggest driver, I would say, for all markets and for the yen as well. If we do get a dollar positive print, then we may see the yen going through that level that we've been waiting for, and then we will have to see how they will deal with that.
Is it 152 on the nose? They're kind of indicating they don't want to have a line for the market to shoot at. So is it exactly 152? And you talked about the commentary around rate hikes. Could they bring rate hikes further forward? Is it just enough to talk about the fact that they could do a rate hike in the second half? Kind of how do these two things fit together?
The 152 level is not like a red mark. They have been trying to stay away of that. But obviously, when you see the price action, the yen never gets there. So that indicates that's what the market expects them to do. They don't want to defy the central bank. And in terms of rate hikes, they could obviously bring it forward. The question on whether just talking about it is enough, I'm not sure. When you look at the past time, the first rate hike we had in 17 years, they have been indicating and talking a lot about that, and yet the yen kept on weakening. So it might not be enough.
What is the current expectation about when we do get another hike? Because, Guy, you were mentioning, we've heard a lot of chatter just in the last few days. I think it was Friday last week, some chatter from UADA, keeping it on the radar, making sure the market doesn't just assume they were one and done. But is there an expectation that we then get another? Because, UADA's a year in now to this job, and he's done this big move. A lot of people have praised him for his handling of it, for the communication, for the fact that markets didn't go crazy as they backed away from their extraordinarily loose monetary policy.
So expectations are a bit all over the place. It may come in coming months. A lot will depend, again, on the next U.S. inflation data and obviously on what we end up, like the expectations for the Fed. We have seen a big repricing over the past weeks. So that will all definitely play in a role in markets.
Is there a belief? It's interesting you make that point. Is there a belief that the BOJ has done a good job? I'm reading a lot more research notes suggesting that actually they made a mess of this hiking cycle, that actually they flagged it too much, that the market had already priced it in, which is why we got the opposite reaction in some ways to maybe what you would have expected. You would have thought the first rate hike in 17 years would have delivered a more positive yen story. It's delivered exactly the opposite. I'm sure you talk to a lot of traders and a lot of people. Is there a belief that actually the BOJ hasn't done a good job here?
I actually see a lot of commentary praising Ueda for his job over the past year. Obviously, the yen is seen as like a weak point because, like you said, it didn't react as you would expect when they finally hike rates. But he was in a very tough position when he got into office because the BOJ was totally out of sync with the rest of the world. They had negative rates, massive asset purchasing and yield curve control program. So they have to change all of that. And he has done this kind of gradually. He started to make tweaks to the yield curve control right when he got in, and then ultimately ended up with the rate hikes.
Yes. So, and some of those positive comments coming from a story that we've got on the Bloomberg Terminal that talks about his first year. And Mitsubishi UFJ saying they give him a score of 70 out of 100. Chief economist at Rakuten Securities goes further, praising UADA's ability to keep markets well informed to avoid shocks. And I suppose that's what comes down to. Do you look at this just through a Japanese lens? Even then, you might praise him for what he's done or not. But from a global perspective, this was something a year ago people were talking about as extremely difficult to enact, and the risks were really high that you get some kind of unanticipated spillover into another market, treasuries, for example. And that we haven't seen. There hasn't been that sort of chaotic event, at least with the first hike.
Yes, but the yen has continued to weaken.
Yes. As if the market hasn't quite turned.
And one of the kind of the big political narratives certainly is that where they want a stronger yen, and that hasn't happened yet. So did they over deliver on the communication? Aileen was talking about the fact that they like to surprise. They really didn't surprise. This was something that was so well telegraphed and so anticipated that actually maybe we got the opposite reaction to the one maybe we were anticipating.
Very good story, though, on the Bloomberg Terminal. Talks a lot about what Ueda likes to do in his spare time as well. He has a little bit of it. Lots of stretching and very healthy eating habits, which, I don't know, maybe that's useful information for
it's good advice to all of us.
Wannabe central bankers. Aileen, thank you very much for joining us. Aileen Oyamada joining us there with the latest on the BOJ, and we wait and we watch with dollar yen currently at 151.92. Coming up on the agenda today, then, we've got at 9 a.m. UK time, ECB lending survey released. We've talked a little bit about that and the significance of that. That is going to be one of the big events, I suppose, of the week. We are, though, gearing our way towards the CPI print of tomorrow, and that's really the big data point to watch. Yes, we've got some Airbus and Boeing deliveries. We'll get to that in just a moment. We also focus in a bit on Irish politics, but from a macro perspective, yes, there's the ECB lending survey, but then it's the CPI print tomorrow.
I think we've just been talking about the impact that it's having on the BOJ story and how it's impacting other central banks. Remember, we are also building up Thursday to the ECB. I am stunned. We've gone through this whole program almost without spending a significant amount of time talking about what could be a really important kind of press conference where maybe Lagarde points to how many rate cuts we could be getting. Is it June? Is it June and July? But we're ignoring all of that. We're spending all our time talking about the US CPI. But then we get the ECB.
That's our fault. Our colleagues at Bloomberg News have been writing about the possibility. You know, a lot of people asking whether euro-dollar actually then moves. Despite Kit Cheeks telling us he doesn't think it will. But there are some people out there who think we will get some movement on euro-dollar as a result of this.
Does the surprise come from the CPI print, or does the surprise come from the ECB? We need to talk about that Airbus Boeing delivery story as well. Let's get maybe a sense of what is happening here. Kate Duffy joins us now from our travel team. Kate, great to see you this morning. What are we expecting to hear in terms of these two businesses? Airbus, in some ways, out in front in terms of the delivery story. It doesn't necessarily have all the problems that Boeing has. Boeing has huge numbers of problems as well. But both businesses are in some ways struggling to deliver. The supply chain is struggling to keep up with what is anticipated and what has been ordered here.
Yeah, absolutely. So we're seeing supply chain issues, as you said, in both. Obviously, Boeing in the quality control side of things, and in Airbus they are experiencing issues with the Pratt & Whitney engines. But what we're looking for is to see how Airbus deliveries fared in the quarter. And we reported last week that the Airbus delivered around 145 planes in the first quarter of 2024. And this is as the company is ramping up production in order to achieve its annual goal of about 800 planes. But as you said, many eyes will also be on Boeing orders, and we'll want to see whether the plane maker has been able to ramp up production after the near catastrophic event earlier this year. And we saw that the FAA put a cap on production of the 737 MAX jet, which is Boeing's key source of revenue, and that's until the agency is satisfied that Boeing's quality control is basically up to scratch.
And where does this leave the cash situation then when it comes to Boeing? We've got the 777 freighter story that I know the team was covering yesterday. Boeing's 777s, a lack of deliveries there, perhaps signalling something a little worrying on the cash side?
Yeah, so that's Boeing's largest freighter. So the cash flow hit from the undelivered freighters that are brand new and don't have any engines attached would account for more than $1 billion, according to Bloomberg Intelligence. So it's a real concern for investors because Boeing recently said that it's set to burn through about $4 billion or more during the first quarter. And it just goes to show that Boeing's issues extend beyond its 737 jet, which has experienced a series of quality lapses over recent months.
Yeah, we don't want to be in the business of building gliders. So what happens next for Boeing? What are the kind of the key next steps that we're watching for, Kate?
So at the moment, all eyes are on the new CEO that potentially will get announced in the coming months. Dave Calhoun is deciding on or participating in how to choose the next CEO. And a few names are being thrown around, but that new CEO has a lot to take on. And not only will they be faced with government scrutiny, but they'll also have to convince customers, airlines, and also the consumers that fly that their planes are safe. So, yeah, Calhoun will step down at the end of the year, but Boeing needs to perform well in the meantime.
Kate, thanks so much. Thanks for joining us. Bloomberg's aerospace reporter Kate Duffy with the latest on the Boeing difficulties, some of the supply chain issues affecting Airbus as well. Quick check on the yen, as we are on dollar yen intervention watch. 151.92 is where we trade currently. We'll take a short break. We'll let you know at the end of that break where we've got to and whether we've seen anything interesting. A lot to focus on, a lot to say about dollar yen and whether we get any intervention there. The finance minister has been speaking, watching very keenly, of course. This is Bloomberg.
My greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
47 minutes into the equity market session, this is what the picture looks like this morning. You've got a story of mild, I think, and I'm being sort of generally polite here, mild European equity market weakness. The stock 600 is down by around 1/10 of 1%. You are seeing some of the metals outperforming this morning, so that's what we're watching quite carefully. We are watching dollar-yen very carefully as well. So we're going to continue to watch that story as well. One of the areas that we have seen outperforming in Europe this year has been some of the defence names, and we're continuing to watch that story in the light of the news that we got yesterday. Germany is said to be forging ahead with a sweeping overhaul of its armed forces, with orders worth as much as 7 billion euros. It's part of Berlin's push to modernize its military following the Russian invasion of Ukraine. It has increased spending. It says it will continue to increase spending, despite actually the current funding program looking like it's going to run out sort of circa 2027. Ollie Crook joins us now from Berlin to give us an upgrade on this. Ollie, what do we know about where this money is going to be going?
Yeah, so what we know about where it's going to be going is, as you say, 7 billion euros it's going to be going across two really major spends. The first is going to be about 3 billion euros on 2 frigates. And this is, these are obviously huge warships, and this is as Germany is trying to boost up their military. And we know they're also going to contracts within Europe, which is also interesting because this is another thread of this, right? So this is going to be the Dutch, the French, and the Germans working together to build these ships. But also there's going to be 900 armored vehicle transportation units, which will be another 4 billion euros, and that is going to Rheinmetall, which we saw open at another record high again today. I mean, we've talked about it a lot on the show so far, and to all the defense companies we speak to. Again, these stocks are absolutely blazing because we don't really know what the limit of how much is that needs to be spent to really satisfy all of these plans. And we understand also that potentially this is the money that's not coming from the principal German budget, but from that off-budget 100 billion euros that was set aside after the invasion. And this is all part of the Scholz plan, the Zeitenwende, the turning point, that big speech he gave in front of Parliament 3 days after the invasion of Ukraine, that the paradigm has shifted for Germany. And that's just the money side of it. We should also mention, Guy, yesterday we saw the first permanent deployment of German troops outside of Germany going to Lithuania. This is really a lot of new precedented territory. This has not happened really since the Second World War.
Yeah, certainly a turning point for Germany and to some extent for other NATO members as well, Ollie. Do we have a sense of the scale of what rearming NATO means? We've talked a lot about just getting to 2%, but then there are questions about whether that goes far enough.
Right, the question of 2% and beyond. So last year we had a record year on defense spending globally. That was $2.2 trillion, right? And we've talked about the shortfall in NATO spending within Europe. We had a report out from EFO and the FT a couple weeks ago saying that that looked like last year 56 billion euros short. Germany was the biggest, most short, down 14 billion. But really, with all of these plans, these ambitious plans that we're talking about throughout NATO, they're talking about a possible spend of not just 2%, but sort of Cold War era spending, closer to 4%. And if you're to hit 4% across the United States, G7, Europe, all of these countries, Bloomberg Economics has crunched the numbers, we're talking about $10 trillion over 10 years. So this is absolutely mammoth. So that sort of very clean figure goes to a very sort of not clean question, which is how do you pay for it, right? And there are really only so many ways you can do so. You can either raise a lot more debt. There is a huge amount of debt already raised after the pandemic. We're coming back down from that. Is that where that has to come to? Raising taxes, or really finding some other creative modes of getting this money. And this is the really big debate that is happening now in Europe and with European leaders. And it's something we're going to talk about, the question of joint debt, the European Investment Bank reform, but they need to find the money to spend in order to get this military where it needs to be in light of what has happened over the last couple of years.
Yeah, is it weapons or welfare? Welfare is certainly being the trade off the peace dividend that we got from the end of the Cold War. Is that now going to start to reverse, and will European politicians allow that to happen? Ollie, some really great questions being raised. I think we've still got to figure out what the answers look like. Ollie Crook joining us out of Berlin. One of the aspects of this obviously comes back to what is happening with government debt and how far central banks really can push government debt with higher and elevated interest rates. That balance is absolutely critical, it seems, for central banks at the moment, though they won't obviously say that. There's the former St. Louis Fed President, James Bullard, saying he expects 3 interest rate cuts this year as inflation moves towards the central bank target. He spoke exclusively to Bloomberg's has Linda Armin from the HSBC Global Investment Summit in Hong Kong.
I think at this point you should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year. And of course, the data can go one way or another, but that's the base case. I think it's been a very successful policy. The policy rate was increased a lot during 2022.
and inflation fell quite a bit in the second half of 2023. Last year at this time, core PC inflation would have been 200 basis points higher than it is right now. That's the committee's favorite measure. So you're looking at a very successful policy with a pretty strong economy. So a lot of things going right for the Fed right now.
So Powell has been right so far?
Yeah, I think he's been right so far, and the committee's been right so far to pursue an aggressive strategy to bring inflation back to target. Most of that was in 2022, and then you bore the fruit in 2023 and into 2024 here.
We talk about how the Fed is data dependent. Powell himself says he is data dependent. What exactly does that mean, and which data in particular is he looking at, should be looking at?
Yeah, I think right now it's mostly the inflation data, because on the real side of the economy, things are going very well, and you can argue about why, but they're going very well. The committee doesn't really have to worry about that side of the mandate right now. All they've got to worry about is getting inflation back to the 2% target, and they've come a long ways back already. It was 4.8%, now 2.8% core PC inflation on a 12-month basis. That means you've only got 0.8% to go. And some people are saying that the next report will lead to core PC being only 2.6% on a 12-month basis. So you're starting to get close enough. I think you have enough data in hand right now to justify the first rate cut, maybe not a whole string of rate cuts, but you could certainly justify the first rate cut now based on the data that they have.
We talk about how the U.S. economy is very strong. So would you say that the risk in the U.S. economy right now is inflation and not growth? Fair to say that?
I think that's right, yeah.
Why is the U.S. economy so resilient? I mean, not too long ago, we were expecting a recession, 100% or, priced in of a recession. Yet here we are with a very resilient economy.
Yeah, last year at this time, you had the bank failure of Silicon Valley Bank and other banks, smaller banks around the country. That was overinterpreted to mean that the U.S. was going into recession. I don't think it was ever a good story to tell, because yes, their banks failed, but they're only a small fragment of the total banking and the total intermediation sector in the U.S. economy. So I think that card was overplayed, and not only did the U.S. not go into recession in the second half of 2023, but the economy actually boomed in the second half of 2023. So you really got a very strong outcome, and that has continued into the first part of 2024 here. Although I would say we're going to be closer to the trend growth rate now, and not way above trend the way we were during the last 6 months of 2023.
That's the former St. Louis Fed president, of course, James Bullard, speaking to our colleague Haslinda Armin earlier on. And really interesting reflections there on the assumptions that a lot of people made about the regional banking crisis in the US and how it would tank the US economy. Yeah. And yet the US economy has been, as we've said many times, much more resilient than anticipated.
A lot of the effects that we were worried about sort of haven't come to pass. So one of the things in the regional banking sort of sector is what happens with the CRE loans. That continues to be pushed down the pike, kind of further away. The risk keeps getting moved further and further on. I think the other risk is the yield story. There's this duration, there's this mismatch that the banks had, and that was kind of the original crisis. Yields have been coming down since then, so the regional banking crisis has been seen as being going away, but yields are going back up again now. Does it re-emerge?
Yes, we've had some very interesting conversations this morning, haven't we, about just how many rate cuts we get, because as yields have been rising on the back of that stronger data, we wait for CPI tomorrow. How many rate cuts can we realistically expect from the Fed with an economy as strong as it is? We've had some really interesting views this morning, both of our guests suggesting that actually, don't take your eye off it. We will get maybe 3 cuts, maybe even 5, some people say. Goldilocks
is going to bump into a wall at some point.
Yes.
Certainly seems to be the narrative at the moment. And when growth slows, it's going to slow down relatively quickly. That wraps things up for us. We've got a great series of conversations coming up on The Pulse. I'll be taking you through that in a few minutes' time. European equity markets waiting for CPI. This is Bloomberg.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, welcome. You're watching The Pulse. I'm Guy Johnson in London. Francine Lacqua is out today. What do we need to know? Let me tell you what we've got coming up on the programme. European stocks a little lower this morning. The yield on the US 10-year hitting its highest level since November. Investors are now awaiting tomorrow's key US inflation data. An interesting conversation earlier with the former St. Louis Fed President, Jim Bullard. He's telling Bloomberg that 3 cuts this year from the Fed, very much the base case scenario. We're going to bring you more from that exclusive interview. Plus, the Japanese finance minister says he's watching FX movements with a high sense of urgency. This is the yen hovers near that critical turning point, 152. We're at a 34-year low. The market very short the yen right now. We need to wait for that CPI print before we get some sort of intervention. Let's talk about where we are with the map this morning. This is what the markets look like across Europe. Little softness out of Germany today, but elsewhere in Europe, I think we're just basically unwinding the gains that we saw yesterday. We are anticipating, obviously, that everybody's going to be really kind of on hold until we see what that CPI print looks like tomorrow. In terms of what US futures look like, let me take you through the picture right now. A fairly flat picture once again, unsurprisingly, given what is going on with that CPI print and the anticipation around it. S&P futures barely budging. NASDAQ futures a little soft, but I wouldn't read too much into any of this if I was being honest. The price action will have to wait for tomorrow for that print to come out. Cross asset, let's take a look at some of the other asset classes we are watching. Similar kind of picture in so many ways. Brent, we're seeing a little bit of a tick up now. We're back north of 90. 90.57 is where we're trading right now. Gold continues to climb. Iron ore actually is probably the biggest story out of this morning's trade and has materially moved some of the miners out of Europe. Iron ore up by over 4% out of the Asian session. Sorry, up close to 4% out of the Asian session. That means that we have seen European mining stocks outperforming this morning. And there you go. There's the dollar-yen trade. 151.91 is where we're trading right now. We're waiting to see exactly where the line is. The market thinks it's 152. It's a little bit north of that. Let's talk about the news that we're getting right now. This is a key piece of data. So this is the lending survey out of the Eurozone that the ECB publishes. And what this tells you is about kind of the credit condition story, the credit impulse story, which has been quite negative for a while. So let me just read you some of the headlines. Banks see more net tightening in standards for firms, terms and conditions. Two firms are broadly stable. So the terms and the kind of cost of money broadly stable. Banks see a positive income effect from rate hikes as they start to fade. That is what is happening to the banking sector as a result of that. Eurozone firms' loan demand declined substantially. So demand has declined really quite substantially, and credit standards for firms tightened a little. So remember, this is a diffusion index. What this tells you is not about kind of what is happening big picture. It basically tells you kind of month on month. Our credit standards, is credit lending improving, declining month on month, and the rate of change on that. Alex Weber joins us now from Frankfurt. Alex, this is a key piece of data that certainly Philip Lane has been citing recently as something that we want to be paying attention to. What can we deduce from it about what the credit impulse looks like in the Eurozone?
So one key piece of data is about the credit standards, and they've been broadly stable, which isn't much of a surprise given they've already tightened pretty substantially after the ECB's rate hiking cycle. And rates have been stable for a while, and credit standards haven't tightened further. So that's not much of a surprise. What was a little more surprising in this survey was that loan demand actually fell further, though banks had expected a slight increase. That tells us that maybe the high level of interest rates is weighing on the economy a little more than officials had maybe expected. That should, in theory, speak in favor of faster interest rates cuts. The question is whether that's going to be enough to sway officials this week. Probably not, because they are also watching a load of other data that has come in a bit more mixed.
Okay. In terms of kind of what we should expect in terms of the economic impact of this, what are we looking at? If credit demand is starting to dry up, where do we see that in the Eurozone economy? If demand for credit is weak, that should be a significant impact on the capital-intensive industries, the industrial sector that has been actually performing reasonably strongly recently.
Yeah, exactly. So that should mostly hit investment from firms and thereby the manufacturing sector. For example, in Germany, we've seen it's been doing much worse than the services sector. It's still contracting as of late, and that should continue to be the case probably as long as corporate loan demand remains weak. There was loan demand from households was a bit better. There was also some easing in credit standards for household loan purchase. That may be a bit a sign that lenders already expect some interest rate cuts to happen later this year. But yeah, as you say, for manufacturing, this doesn't look good.
It doesn't look good. It's interesting that we are seeing outperformance of European auto stocks. Some of the noises coming out of the industrial sector starting to maybe improve a little bit. Alex Weber, thank you very much indeed. Alex Weber joining us from Frankfurt. Yari Stein is the chief Europe economist at Goldman Sachs and joins us now on set. The lending standards, I think, is interesting. The demand for loans that we're seeing is really interesting out of this survey. When you look at this data and you see that demand for credit is beginning to kind of weaken materially, what does that tell you about kind of where we are in the cycle, how close we are maybe to the bottom?
Yeah, I think it's telling you that demand growth in the economy is still weak, particularly in the industrial sector. And I think that squares generally with particularly the hard data and the German data as having been very soft. Yep. But you also see in the credit standards, which I actually think are the more important part of the survey, that things are still tightening, but things are not tightening at a slower pace. And I think that also gives you a little bit of hope that we are through the worst in terms of the credit impulse, and that the forward-looking indicators are beginning to look a little bit better. And I think that squares also with what we're seeing in the surveys, in the PMIs, in the more forward-looking surveys that are a little better. So I think it's consistent with the spot data still being very weak, but the forward-looking indicators looking a bit better.
So if you're Philip Lane, if you're the chief economist over the ECB, you're citing this survey as being very important. What would your take be to the Governing Council when it meets later on this week?
I think for now, I would say that we need to see more data to confirm that the inflation deceleration is on track. So I think we're very unlikely to get a big shift in the message this week. But I do think that the weakness in demand that we are seeing, I think the indications on wage growth slowing, and I think the inflation projections all suggest that the first rate cut is coming nearer. We think they will reiterate this week that we will see a lot of data by June, that we will be able to determine by June whether to start lowering interest rates. And I think the cut in June is very likely. And the debate now really is shifting towards the pace, whether you might want to go quarterly or you might want to go back-to-back or do a mix.
What do you think?
I think that a back-to-back pace is more likely, at least initially. I think we have strong evidence that policy is restrictive.
Yep.
I think we are gaining confidence that inflation is coming back to 2%. The Governing Council has decided to wait a bit longer than some members would have preferred. And so I think once the process gets underway in June, I think the path of least resistance would be to do a series of cuts initially, so June, July, September, because everyone, I think, can agree that even after 3 cuts, policy is still restrictive, and then you reassess in September where you stand.
So that raises the question, why do 325s? Why not do a 50? If we're going to front-load policy, why don't we just front-load policy?
I think central banks like to be predictable. They don't like to move in big increments very suddenly. I mean, they had to when inflation rose very rapidly, but I think that was a little bit of a special case. And they don't like to move in 50 basis point increments, particularly with the first move. And so I think it's more likely we start with 25. I don't think there's going to be a strong message this week or in June about committing to a particular series of moves. I think President Lagarde has been...
So why not? Why? It's an interesting debate. Why, if you don't want to surprise the market, when do you need to start preparing the market for that more tightly packed sequence of rate cuts which could be coming? Now, the market in some ways has already got that price, so in many ways maybe you don't have to. But when does that communication process start?
I think you do it with the data. I think, as you said, I think they can be happy with how things are priced at the moment. And then you wait for the data to come in. And if the data confirm that the disinflation process is on track, I think it's then quite easy to say, look, the data are on track. We want to normalize policy. So I think they want to avoid really committing to a particular path. I think they want to avoid making it a one-way street to 2% in a straight line. And they want to put weight on the data, which, of course, is the right thing to do. But given our forecast of how we think wage growth will evolve and how inflation will return to 2%, I do think it's likely that we're going to see a series of cuts this year.
Tricia used to give us little code words. I wonder if we need to go back to that. Jari, stick around. I want to talk to you about we talked about the monetary side. I want to talk about the fiscal side as well. We'll do that in just a moment. Jari Stein, Chief European Economist at Goldman Sachs, is going to stay with us. Coming up as well, a new era of global rearmament is gathering pace. This is part of the story on the fiscal front. This is the West contends with growing threats from Russia, China, and also the threats coming out of the Middle East. We'll talk about that story next and what that means for government finances. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time, surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
We've talked about the monetary, let's talk about the fiscal. A new era of global rearmament is now gathering pace, understandably given the geopolitical risks that lie out in many parts of the world right now. The US and its allies coming to terms with the big increases that are going to be required to counterbalance the threats that we now perceive from Russia and from China and the threats that are coming out of the Middle East. Bhargavi Shaktiwal joins us now to talk about this key economic story that we are covering. Let's talk about the appetite that now exists. We saw yesterday Germany announcing a big deal to increase spending on armoured personnel carriers and frigates. How much political appetite is there in Europe to scale up the defence industry to Cold War scale types of numbers?
Well, defence spending reached a record $2.2 trillion last year, so it's not that far away to think about this increase in defense spending and this appetite for it. Mainly it's being driven by, in Europe, Russia's aggression in Ukraine has been a major wake-up call. And then on the other side, you've got China's rising military might and its investments, which is actually also the looming threat of Beijing moving on Taiwan. We see the political unrest in Ukraine, in Middle East. All of this after years of limited defense spending following the Cold War. More and more European nations are now stepping up and spending more in light of all of these threats. So yeah, the appetite is increasing.
In terms of how we finance this, how's it going to work? Is this going to come out of national budgets? Is this going to come out of pan-European debt? What is the current thinking? Because the numbers are big, and it's going to be interesting to see exactly how ultimately Europe deals with this problem.
Absolutely. So we looked at 2 scenarios, and one of our scenarios is defense spending increasing to 2% for all the countries, and the other one was 4%. And in the 4% scenario, our calculations show that the total numbers could add up to over $10 trillion over the next decade on just defense spendings and borrowings to finance this. But where does the money come from? Well, there's a difficult trade-offs for the governments to take. If they borrow more, we're currently in a period of extremely high prolonged interest rates, which would be extremely expensive. It could impact economic growth. It could have further tightenings of government budgets along the way. But on the other side, if they spend it on, if they finance it by cutting spending or increasing taxes, that's also a problem, especially in terms of low economic growth.
Bhargavi, thank you very much indeed. Bhargavi Shaktiwal joining us from Bloomberg Economics on the spending challenges around this defence story. Yari Stein, Chief European Economist at Goldman Sachs, still with us. On the fiscal front, can Europe do it all? Can it continue to finance welfare at the same time as financing a big weapons program? Can it continue to push on with the green investment challenges that Europe faces as well? Is there the money? Are there pots of money available to do it all?
It'll be a challenge. There are some pots of money remaining. If you look, for example, at the NGU, the Next Generation EU, there's some remaining funds that could be repurposed. There's a little bit of discussion around that. There's also, of course, ultimately fiscal space in the core countries, if you just look at debt levels in Germany. But of course, you have institutional constraints there. So I think there it's a little bit more of a political question rather than an economic one. And so I think it will be a challenge, but I ultimately think that you will find different sources to finance this spending.
Is this the key moment for Europe, though? We had the moment during the pandemic where we did joint financing. And that felt like something that I've been covering this story ever since the euro was created. And that's been the moment we've all been waiting for, this kind of, we've had the monetary alliance, and now we're starting to get the fiscal kind of common approach being taken as well. I was told at the time it was a one-off. But do you think it is going to be a one-off? Do you think ultimately Europe will decide that actually financing defence, for instance, is something that should be done jointly? And if so, how big a moment is that for the Union, for the Eurozone?
I think we are heading in that direction. I think the creation of the NGEU really was a watershed moment. It set the precedent. It was, of course, meant to be a one-off, but it set the institutional precedent of how you can go about to finance EU-wide programs. And so I think with that precedent in place, I think there is room to build on that over time. It is, of course, a difficult decision for various reasons, for political, for institutional reasons, but I do think we will move further down the line of integration. And we've also often seen that Europe moves when it is under pressure, economically or politically.
But in terms of how pivotal that could be, we've missed we've had the kind of the monetary framework, but we've been looking for the fiscal framework. How far could that take us? Is it just joint financing of big projects? Do we start to see more fiscal transfers in the way that maybe actually you need to have a properly functioning monetary union? Is this kind of the first step down that road?
I think it probably is, but I think it's a slow process. It's a complicated process. I think for now, I think of it more as joint financing of big, more one-off projects. There's also, of course, initiatives around things like capital markets union, which is another important part of risk sharing. We might make some progress there. And then, of course, there are also debates around things like common unemployment insurance, sort of more cyclical backstop. So I think you do have discussions on all of those fronts, but it is going to move relatively slowly. And I think the one-offs are probably going to be the bigger changes for now.
You start to add all the one-offs up together, and maybe they start to amount to something. That takes me to my next question about what we've seen, rather surprisingly, is peripheral outperformance within the Eurozone versus the core. And some of that is down to the NG funds and how they're being spent. How big an impact, how sustainable is that impact, do you think, in terms of the effect on Italy, particularly Italy maybe, because of, you've seen the Meloni government spending an awful lot of money, which has propped up some of the economic numbers that we've been seeing. It has had an effect. In some ways, this is fiscal transfer. Is it something that is going to carry on and can be sustainable?
I think there are two main reasons behind it. One is the fiscal that you mentioned. The transfers, the recovery fund spending is one reason that we are seeing support for the South, and it's a drag on the North. I think that's one reason for that economic divergence. But the other one is, of course, that the South is more services intensive, the North is more manufacturing intensive, and we are seeing more weakness in manufacturing, and we're seeing rising real incomes that is supporting services. So I think there's also an important economic story for that divergence. Now, how long can it last? We do think that this year the South will continue to outgrow the North quite substantially. But of course, we are also seeing that debt levels, for example, in Italy are high. They're probably going to edge higher from here. The deficit has been revised up. And so I think it is a reminder that there is also a narrow fiscal path that some of these higher debt countries are walking. And so we do think that there's going to be a little bit of upward pressure again on sovereign spreads as a result of that.
Okay, they certainly tightened up significantly of late. Jarek, great to see you. Thanks very much indeed for stopping by to see us. We really appreciate it. Thank you very much indeed. Jarek Stein, Chief European Economist, joining us from Goldman Sachs. Plenty more still to talk about this morning. We're building, of course, towards that CPI print, and we're watching very carefully what is happening with dollar yen this morning. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
We're still investing in China because we see that long-term potential. Transition is taking place. Now is the time to invest, in my view, in China, to be part of that transition and the future growth.
Investors, what I hear here, are looking for these growth companies in China that they've been hearing about, that they've been seeing. That's starting to stimulate secondary market growth.
But we're actually underweight China at the moment. You know, the overhang of the real estate, going into consumer confidence, business confidence. We're starting to see net inflows. We're starting to see those policies coming through.
Some of the HSBC executives that we've been speaking to exclusively at the bank's Global Investment Summit, which has been taking place over the last couple of days in Hong Kong. Some really interesting kind of lines coming out there on what is happening with China. I want to take you as well to what is happening in Japan right now. Keep a firm eye on what is happening with dollar-yen right now. The expectation is that we are going to wait until we see the CPI print out of the States tomorrow before potentially we do see yen intervention in the dollar-yen trade. 151.90. The market seems to think that the line is at kind of 152, but is it slightly north of that before we start to see some action? Anyway, keep an eye on that. Keep an eye on euro-dollar as well, going into the ECB meeting as well. We're going to talk about what is happening in the Middle East next. That is coming up. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Well, when I was younger, I used to be in bands. I played drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
And the second is obviously China and the economic growth in China. If we briefly speak about oil, as you mentioned, oil is trading at around $90 per barrel for Brent, and this is nearly 6 months high. And this is driven by a very high geopolitical premium due to the ongoing conflict in the Middle East, but also the recent attacks on the Russian refineries. And we do anticipate this volatility to continue because on the one hand, OPEC Plus is continuing to manage supply side for oil, but on the other hand, there is a very high spare capacity. It's over 5 million barrels per day. So if there is any significant escalation, for example, in conflict, and there is an uptick in the oil price, it's likely to put a cap. But then on the other hand, there is a moderation in the global demand growth for oil, which is now anticipated at about 1.3 million barrels per day, which is well below 2 million barrels per day we saw last year. And most of this demand is expected to come from China. So whilst the markets are balanced, the balancing act is coming from OPEC Plus continuing to manage the supply side.
Okay, there's a lot in there, so let's just unpack some of it. You talked about the fact that maybe the risk premium, the geopolitical risk premium, is high right now. How high really is it? For a long time, it felt like the market could ignore the geopolitical risk because of the solid supply side story that you referenced there. How much do you think it has increased? If I look at $90 a barrel, how much of that is risk premium? How many dollars a barrel do you think that we're looking at?
It's difficult to estimate from the mathematical standpoint how big is the geopolitical risk premium, but it is usually between $5 to $10 per barrel. And if you think about it, when the supply and demand is balanced and OPEC Plus is managing the supply side, there is a reasonably solid demand growth story. We saw oil price for Brent around $80 per barrel. And this is where we think the geopolitical premium was around $5. But then now it jumped to about $90 per barrel. And this is an expansion of the geopolitical risk premium, if anything.
So how much higher could that geopolitical risk take us? Could it take us, as someone's suggesting, towards 100?
It really depends, because if there is an escalation of the conflict, if, let's say, there is an impact on Strait of Hormuz, obviously the oil prices can skyrocket. But as I mentioned, the spare capacity for OPEC Plus is very high. It's over 5 million barrels per day, and that will serve as a cap on any sustainable increase in prices. But having said that, it doesn't remove the possibility of an uptick in oil, of substantial uptick in oil prices if the conflict escalates.
Let's talk a little bit about iron ore. Iron ore up sharply overnight. Is that based on an expectation that we are going to see a Chinese recovery? What do you make of what we're seeing in terms of the trajectory there?
So in terms of the iron ore, the market was relatively bearish during the first quarter of this year. The iron ore prices collapsed from $140 per ton at the beginning of the year to about $105, $103, and our expectation for this year is $105. There are a couple of drivers. One is the bearish sentiment from China. The other one is an increase in inventories in Chinese ports. But having said that, we anticipate the global crude steel production to be reasonably flat this year, and also Chinese crude steel production to be flat. So this will provide the demand support for iron ore. There were a couple of interruptions, operational interruptions on the supply side at the beginning of this year. This provided support to the prices. But then generally the supply side was reasonably strong during the first quarter, and that pushed the prices a little bit down. But taking into consideration the energy transition and taking into account our expectation that the crude steel production in China is likely to moderate in terms of the growth, it's likely to go down over the next 5 years on average, let's say 1 or 2%, that will put a cap on the growth of demand for iron ore. So we do expect the prices to moderate going forward.
Angelina, there's a lot of questions being asked about why we are seeing the rally in gold right now. There's a lot of head scratching going on. Why do you think it's happening?
Well, gold is generally a safe haven. And going back to the point about the geopolitical premium that we discussed, that's the natural reaction of the gold market.
Okay. Angelina, thank you very much indeed. Angelina Valavina, head of EMEA Natural Resources and Commodities, joining us from Fitch Ratings. Thank you very much indeed. I want to kind of explore one element of this story, and that is what is happening in the Middle East in maybe a little bit more detail. Senior Israeli officials are now saying the progress has been made in negotiations for a ceasefire in Gaza. That would include the release of hostages and Palestinian prisoners. It's a move that is drawing criticism from far-right ministers in the Netanyahu government who have threatened to bring down that government. Joining us now, Ethan Bronner, to dig into this. What do we know about how close potentially this ceasefire deal is? Kind of what are the key sticking points still that need to be decided?
Well, actually a fair amount, it looks like. The Israelis expressed optimism yesterday because the Americans, who were sort of the key drivers in this, came to them with a deal that they thought they could deal with. And the difficulty now seems to be that Hamas, on its side, has not responded very positively to what's been offered. We'll see. We think it'll take a couple of days. I think it's about a 50-50 situation. The big issues have to do with Hamas has some fairly strong demands that Israel ultimately, in the beginning, promised it will remove all of its troops and will no longer be involved militarily in Gaza. That's not something Israel's been willing to promise at this stage. And then there's an issue about how and how many Gazans who live in the north of Gaza can go back home from the south. So those are the issues on the table right now, in addition to what kinds of Palestinian prisoners held by Israel, how many and what kind would be released in this deal. So there's a lot still to negotiate, but there is a sense of movement that there hadn't been before.
Will the Netanyahu government survive such a deal?
Well, that's a very good question. They have a meeting tonight at the Security Cabinet. The far-right members of his coalition have said, if anything we're hearing, which is that the Israelis removed their combat troops from Khan Yunis in the southern part of Gaza in the last couple of days. They're saying if this is a sign that we're stopping the fight and we're not going to go into Rafah ultimately, and that you're going to yield to Hamas in this deal, we're going to bring this government down. Netanyahu responded last night with a little video in which he said, we're going to go into Rafah when we need to. We have a date for it. So everyone is talking very hard line, both Hamas and Israel, publicly, and then in Cairo at the negotiations. There seems to be a greater sense of flexibility, but it is very difficult to know where this is going.
The international pushback, though, continues to mount against an invasion of Rafah. The condemnation of how the Israelis are conducting this war getting greater and greater. The Turks are the latest to push back, and we're seeing certainly a trade spat emerging there. In terms of how much that pressure is being recognized in Tel Aviv, in Israel, to what extent is the Netanyahu government responding to it? Is that maybe some of what we saw yesterday in this comment that we got from Netanyahu?
I think it is. I mean, I think that the domestic political needs in this country for Netanyahu is not to be seen to be yielding to international pressure on what's going on in Gaza. So therefore, his pushback is very strong. In the Turkish example you just gave, the Turks have said, well, we're going to take certain items off of our list to export to Israel. And the Israelis have already responded and said, well, we're going to create a list of things we won't allow you to export to Israel. Now, at the moment, concrete and steel are quite significant imports by Israel from Turkey. So I don't think it's going to be pain-free for Israel, but there's a very much, we can take it, we can stand up to the world all by ourselves. We've done it in the past and we'll do it again. That's the sentiment. The reality is somewhat different.
Ethan, thanks for the update. Complicated picture. Thanks for maybe breaking it down for us and letting us understand what's happening here. Ethan Bronner joining us from Israel. Coming up, we're going to take another look at what is happening in the currency markets. The yen holding close to that 152 level. Plenty of speculation around about intervention, but when does it actually come and at what level? And as it posts that CPI print tomorrow out of the United States. More on that next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
43 minutes past the hour. Jim Bullard used to be super hawkish, certainly at the beginning of this rate hiking cycle we've seen out of the Fed. That was the narrative. Sounding a little bit more circumspect now. So he's now formally of the St. Louis Fed. He's now at Purdue University. But he, in Hong Kong overnight, was saying he now thinks that 3 interest rate cuts this year from the Fed, probably the base case. This is inflation moves back towards the central bank's target. He spoke exclusively to Bloomberg's Haslinda Armin from the HSBC Global Investment Summit, which is taking place in Hong Kong.
I think at this point you should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year. And of course, the data can go one way or another, but that's the base case. I think it's been a very successful policy. The policy rate was increased a lot during 2022. And inflation fell quite a bit in the second half of 2023. Last year at this time, core PC inflation would have been 200 basis points higher than it is right now. That's the committee's favorite measure. So you're looking at a very successful policy with a pretty strong economy. So a lot of things going right for the Fed right now.
So Powell has been right so far?
Yeah, I think he's been right so far, and the committee's been right so far to pursue an aggressive strategy to bring inflation back to target. Most of that was in 2022, and then you bore the fruit in 2023 and into 2024 here.
We talk about how the Fed is data dependent. Powell himself says he is data dependent. What exactly does that mean, and which data in particular is he looking at, should be looking at?
Yeah, I think right now I think it's mostly the inflation data, because on the real side of the economy, things are going very well. And you can argue about why, but they're going very well. The committee doesn't really have to worry about that side of the mandate right now. All they've got to worry about is getting inflation back to the 2% target. And they've come a long ways back already. It was 4.8%, now 2.8% core PC inflation on a 12-month basis. That means you've only got 0.8% to go. And some people are saying that the next report will lead to core PC being only 2.6% on a 12-month basis. So you're starting to get close enough. I think you have enough data in hand right now to justify the first rate cut. Maybe not a whole string of rate cuts, but you could certainly justify the first rate cut now based on the data that they have.
We talk about how the U.S. economy is very strong. So would you say that the risk in the U.S. economy right now is inflation and not growth? Fair to say that?
I think that's right, yeah.
Why is the U.S. economy so resilient? I mean, not too long ago, we were expecting a recession, 100% or, priced in of a recession. Yet here we are with a very resilient economy.
Yeah, last year at this time, you had the bank failure of Silicon Valley Bank and other banks, smaller banks around the country. That was overinterpreted to mean that the U.S. was going into recession. I don't think it was ever a good story to tell, because, yes, their banks failed, but they're only a small fragment of the total banking and the total intermediation sector in the U.S. economy. So I think that card was overplayed, and not only did the U.S. not go into recession in the second half of 2023, but the economy actually boomed in the second half of 2023. So you really got a very strong outcome, and that has continued into the first part of 2024 here. Although I would say we're going to be closer to the trend growth rate now, and not way above trend the way we were during the last 6 months of 2023.
Jim Bollard speaking to us out in Hong Kong at the HSBC event, formerly, of course, of the St. Louis Fed, now of Purdue University. I wonder if he's a basketball fan. If he's not, he probably should be. Let's talk about another aspect to this story, and that is what is going on with the yen. We're all on tenterhooks, waiting for a couple of things. One of which is the CPI data out of the United States. The other one is how the BOJ responds to that. You get a strong print out of the States, as I said, the dollar higher, the yen lower. Does ultimately the BOJ, do the Japanese authorities step in at that point? Aileen Oyamada joins us now on set to discuss. Is that what we're waiting for? We need to get through the CPI print, right?
Yeah, definitely. We will hardly see something before CPI, I would say, because as you said, it will move markets all over the world. But markets are definitely waiting for intervention at any time from Japan. We are at the yen levels are weaker than when they were when they last intervened. Yep. And the 152 level is widely seen as something that authorities are watching for, and also when you look at options, it's something that is important for the market. So.
The market's not brave enough to go beyond 152 at the moment.
Yeah, that's what you're seeing.
It's kind of we keep bumping up against that sort of level. Is it 152? Is that the line? How fuzzy is that line?
Yeah, so we've been hovering around that level for 3 weeks now. I think it's not a line that authorities have drawn. They are actually trying to steer away from saying that's the level we will intervene. But it was close to that 30-40-year level, and technically we had some options expires already in that level. So that means markets were positioning for that to be kind of the extreme. And they are trying to avoid testing that, like you said, because no one wants to really defy the central bank at this point.
In some ways, it's a surprise that we are where we are right now. After such a long period of time of negative rates, for the BOJ to come through and hike rates, logically, my mind would have told me that we would have had a stronger yen, but we've ended up with a weaker yen. Do you think this is where you are expected to be at this point, given the policy change that we've seen?
Yeah, so when you look just to Japan policy, you could think about our stronger yen because they hiked rates after 17 years. But when you compare to the rest of the world, yields are so low in Japan. Rates are so low. Yeah. They are just coming out of negative rates. We had this huge, massive rate hiking cycle with the Fed, with the ECB, all over the world, really. So the yield advantage is something that it's really hard to combat when you're a currency trader.
The carry trade's still on and will be on until maybe things change more significantly or they push back. Aileen, thank you very much indeed. Aileen Oyamada, having a very busy time right now. Maybe it's going to get a little bit busier. What are we going to talk about next? Airbus and Boeing out with their delivery numbers. Remember, deliveries are really important. That's where these companies ultimately get their big kind of cash push from. How are these numbers going to turn out? Both companies facing their own different problems right now. Maybe Boeing a little more than Airbus. We'll talk about that next. This is Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
So Airbus and Boeing are set to announce Q1 deliveries a little bit later on today. With a threat to demand from rising geopolitical tensions, what should we expect from these results? I think it's the supply chain story that we're probably going to be focusing on. We know what the problems, we hope we know what the problems are at Boeing, but is it all really plain sailing for Airbus? Benny Campbell joins us now, Bloomberg's global editorial leader on aviation, joins me now on set. We know what the issues are with Boeing. How are they going to manifest themselves in terms of these numbers?
Well, it's really a question of how bad will the numbers be. I think the market is expecting a bad set of numbers. It's just sort of where is the floor at this point. So we're probably expecting, 20, 25 orders in terms of the 737. You've got to remember they're capped in terms of what they can actually do. We have the FAA, the regulator. They're sort of checking what they can do, and they've capped the number of output until they're satisfied with the production. So there's really not a lot that Boeing can do at the moment. And they have said deliberately, we want to go slow. So even with a regulator, they're saying, we're probably going to do less than that.
We actually need to get this right.
Yes.
Airbus, I think, is a much more interesting narrative because in some ways, we've kind of ignored Airbus and we've been focusing very much on Boeing. But they are going through a big supply ramp right now. And I'm wondering how kind of smoothly that's going. What is happening further down in the supply chain? Are they getting what they need in order to deliver the aircraft that they are promising?
It's still a big issue for them, and whenever you speak to Guillaume Faury, the CEO, he still says, look, we're not out of the woods yet on supply chain. Yes, the pandemic's behind us, and yes, things are better, but don't forget they have issues with the engines on the 320, the RTX engines. Those are a problem. A lot of planes are on the ground. They have issues with the bigger planes. So, yes, they want to ramp up, and obviously they're in a much better place than Boeing is right now. But as you say, they still have issues.
So we'll continue to watch. This is still a supply chain story for both, well, certainly for Airbus.
Yeah.
Benny, thank you very much indeed. Benedict Campbell, Bloomberg's global editorial leader on aviation. Before we wrap up the program, quick look at what's happening with the markets. Dollar yen, keep a firm eye on what is happening here. We are watching that 152 line very carefully. There we go. There it is, 151.88. Keep an eye on euro dollar as well. How much divergence are we going to see this week? We've got an ECB meeting coming up Thursday that people, I feel, maybe are ignoring a little bit. You want to pay attention to that. Anyway, the brief is up next. Danny Berger, Manus Cranny, continuing the conversation in New York. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The 10-year yield eyes 4.5%. Markets settled on 2 rate cuts this year, though the former Fed official, James Bullard, eyes 3.
Israel signals fresh optimism on ceasefire talks in Gaza as Hamas claims there's been no progress.
And commodity traders had another blockbuster year, raking in billions in 2023. She survived the eclipse.
I mean, my eyes hurt a little bit. I did use the glasses, but, you know, you're still kind of looking at the sun.
Good to see she took the medical notes. Let's talk about these bond markets. Will we survive? What's going to happen when we trade? If we trade 4.5%, because there is almost a breathless sense in this market that we're one moment away from breaking the 4.5%. Could it be that the CPI data tomorrow is the one that does us in? Now, the New York Fed inflation expectations hold at 3% for the 3rd month in a row. Sticky and enduring inflation will be the challenge for the Fed. Bullard talks about 3 rate cuts and the dramatic success of policy. Dollar yen, you're on tenterhooks. If you're not waiting for CPI, you want to see what level and scale of intervention there may be in the yen. It's at a 34-year low. There's no hard line in the sand from the Bank of Japan, but the finance minister this morning, Suzuki, says developments with a sense of urgency. He's watching those who waited. The Bank of Japan says desirable for FX to move in a stable manner. Well, it's been drifting around this level. What will they do if we break 152? Oil is back on the bid again, up 0.5%. We gave some back yesterday. Goldman Sachs, you got it. The note is in the inbox. $100 oil if there is a significant interruption upstream, downstream, or indeed midstream. That could take us to $100 oil. Danny, good morning.
Good morning, Manus. Well, in the meantime, in equity land over here, there's little to really drive any moves in either direction. We're unchanged for both the S&P and the NASDAQ 100. The good news about that, though, is the volatility is subsiding that we saw from that momentary spike last week. It does show that more puts are being had in this market. But it's interesting, Chris Harvey over at Wells Fargo yesterday upgrades to a fresh bullish target, 5,535, which is kind of such a specific number that it's ridiculous that I love it. But he says the way people are thinking about valuations is now different considering AI. You can't use the traditional metrics. European stocks down 0.2%. The only thing really doing better is energy and materials. We had BP earnings, yet again, a strong, I should say strong trading figures from BP. But the interesting thing here, man, is we're not seeing cracks as yields go to year-to-date highs. As we try to judge what cuts are happening, how many, 2, 3, what have you. And on that note, as you said, Manus, we did hear from the former St. Louis Fed President James Bullard. He was speaking at the HSBC Global Summit in Hong Kong to discuss his thoughts on how many rate cuts he sees this year.
You should probably take the committee and the chair at face value. I think their best guess right now is still 3 cuts this year. And of course, the data can go one way or another, but that's the base case.
And Bullard there really is just echoing Daly, Mester. We've heard many Fed officials say it's 3, but it's so fascinating to see that we're now fighting the Fed again, but on the opposite side of a market that's just pricing in 2 cuts.
Yeah, and I mean, he does go on to talk about the dramatic success of the Fed's policy. Of course, the argument there would be is that you've had dramatic turnaround in the supply side rather than the residual impact of 500 basis points of hikes.
I'm sorry, but if you're a former Fed official, of course you're going to say it was successful.
Absolutely.
You got to talk your own book. All right, let's widen out the conversation. Joining us now is Katrina Dudley, investment strategist at Franklin Templeton Investments. Katrina, has the market gone too far for hearing from Bullard saying it's going to be 3 cuts, believe the Fed when they say that, and now we've moved to 2?
Okay, so number one, there is a difference of opinion. You look at like a Neil Kaskari who says 0 rate cuts are going to come in this year. And if I look at the beginning of the year, which isn't that far, that many months ago, we were looking at 3, 4, even 5 cuts. So I think that the market is still uncertain. What does that say to me, though? It says that we have flexibility, and that's such a great thing. Look at Jamie Dimon's letter, which came out. He's looking at what? The market's saying 70%, 80% chance of a soft landing. Well, what if we're wrong? We have tools here. We have the ability to cut rates and stimulate the economy if we see those signs of weakness. So it's flexibility, and I think that that's really what's driving valuations here.
I was drawn to a line from Goldsby yesterday. He talks about, I love this, there's a normal boom time. Where do you want to be most exposed? Beyond tech, we will get to tech, I promise you. You can have it in there as half an answer. But where do you want to be exposed most now in a normal boom time? And how long do you think it will endure? Do you think we're in a new cycle of a normal boom time?
Okay, so let's separate 2 markets because the U.S. has, is in a kind of upswing and probably later in the cycle because it didn't have any type of downturn. But if you look outside of the U.S., we have so many markets which went either into recession or were so close going into recession, and those markets have definitely boomed or come out of that recession, but they're not in that kind of boom period. So we definitely, for once in a long time, have differing cycles and different places where we are. In terms of the market, though, in the U.S., what is driving this kind of continued acceleration? And it's AI. And a lot of people are trying to predict the end of AI. I would say that AI is a theme today, but AI's been in our life for so many years. It's just the use cases are becoming more transparent.
Well, it's OpenAI. All of a sudden, we're all exposed to how powerful AI is, so we've woken up to it. What do you make of Chris Harvey's argument over at Wells Fargo saying that the normal valuation metrics don't apply for investors anymore because they're looking at the potential of AI? You can't say, oh, these are expensive. It doesn't work that way anymore.
I think we said that back in the internet bubble, that the valuation doesn't apply. Valuation matters, okay? That is the baseline assumption because the returns that you make are a function of what you pay for a stock today and what you think it is worth in the future, and both of those are valuation-centric measures. So I do think that valuations definitely play a role. Where could we be, wrong is that AI is going to accelerate the growth, and it's going to accelerate the pace at which companies get to those forward earnings number because they'll get cost efficiency. So if I look at where I think we could be wrong in our models, it's actually we could be wrong in terms of how much this generates margin-wise and cost savings-wise.
Do you think maybe that's why some people question how stretched some of the valuations are in the Mag 7 at the top end, and that's going to become a little bit harder to justify? We did a piece yesterday in terms of look at the global markets for the next AI iteration, not the NVIDIA, not the Meta, not those stretch valuations in the US? Does it just become harder to defend adding at those levels in the US names?
I think most of these tech names have got a lot of the AI opportunity priced in. I think you're right. That said, even at these valuations, as long as they grow earnings, those stocks, if they just maintain the valuation, can continue to perform at the rate of earnings growth. And they actually could have a little bit of valuation weakness and still perform because they are growing so strongly. But where in the market are we surprised? I'm just surprised at how many use cases there are for AI. And I think you're going to start to see AI bleed into other parts of the economy. You're talking it bleeding into financial services, and so it could provide a lift there. It's bleeding into the industrial market and making, you're driving returns there. So I think that that's the opportunity.
But I mean, at the same time, you see things like, I don't know, my toothbrush, for example, doesn't need AI. It does feel like there are some circumstances where companies, I mean, it's not as successful as it was in quarters past, but just talking about AI just to get it out there, maybe so the algos see that they're talking about AI and bid up the price. How do you distinguish what companies are promising too much?
Okay, so let's take your toothbrush example. It didn't take me that long to train my children on how to brush their teeth. It used to take 6 months to train a robot on how to brush your teeth because of the amount of sensitivity you need to squeeze the toothbrush. That time has now compressed significantly, and I laughingly use toothbrushing as an example, but that's where you've had so many of the benefits in the compression of the time it takes. And so that's where I see some of the real benefits, is that it's just going to come into our lives so much quicker than we anticipated.
So as you talk to the teams then about how you broaden the search for AI, just give us an example of what that is on a sort of daily, monthly basis in terms of how you expand the search.
I think it involves talking to companies and understanding the use case, and also understanding the culture at the company and the willingness of their organization to embrace AI. Because Jamie Dimon at JP Morgan can identify 400 use cases for AI, but he's got to have 400 divisions that are willing to use that technology. You can give them that technology, but if they're not using it to enhance their productivity, you're never going to see the benefits, and all we're going to see is the cost, and you're not going to get the follow-on earnings growth.
Now, recently, the rally, Katrina, though, it has been more than tech. It has been more than AI. We've seen a broadening out. Energy hits a new record. Industrials, financials, all at all-time highs. Can that broadening out last, and could we even see a leadership shift? It sounds like not. But potentially those are the companies who are incorporating AI that aren't those classic tech plays.
Yeah, I think that, look, what we're looking at in this market and what we're very aware of is what are the risks? Because we're talking about Goldilocks here. I mean, it's great, isn't it? GDP growth is strong. Inflation is under control. The Fed is very steady as he or she goes. So the Goldilocks is the norm, and it's what's priced in. And if you're looking at a landing, it's a very nice, gentle, soft landing. So what are we talking about with our teams? The risks. And I think you need to be, as an investor, very aware of those risks. One of the risks that we do see coming into the play as we get closer and closer to November in the US is the election cycle. That cycle is also playing out in other parts of the world. We're not the only people going to the polls this year. 41% of the global population will be joining us. And so as you look at an election, you need to be aware that the election is a binary outcome because one or the other party wins. And so that creates some uncertainty. So we're looking at the sectors that whether or not they're pricing in that. So that is the other side of all this bullishness, is that we need to be aware of those risks.
And you have defense down there squarely as being the one area that wins, regardless of who comes through. Thank you so much for being with us this morning. That is Katrina Dudley of Franklin Templeton Investments. Setting the agenda. Other stories trending on your Bloomberg terminal this Tuesday morning. UBS is in discussions to attain full ownership of its China platform. Sources say it's proposing to buy the remaining 33% stake in UBS securities from the Beijing government fund. Now, in return, it would sell part or all of its position in Credit Suisse's securities unit to the fund.
Blackstone is said to be nearing a deal to take cosmetics company L'Occitane private. Sources say the private equity firm may team up with the cosmetic giant's billionaire owner for the buyout.
Sunday's broadcast of the NCAA Women's College Basketball Championship drew a record TV audience. The game between the victorious South Carolina Gamecocks and Iowa Hawkeyes drew 8.7 million viewers. That was on ABC and ESPN. Numbers made the final the most watched women's college basketball ever.
Go Caitlin Clark. All right, Senate Republican leader Mitch McConnell supports a bipartisan effort to pass the bill forcing TikTok's parent company to sell the video sharing app. He says that requiring ByteDance to divest from TikTok lands squarely within established constitutional precedent and says this matter deserves Congress's urgent attention. All right, coming up on the program with Manis and me, fresh optimism coming from the Middle East on ceasefire talks. We're going to have that for you next here on Bloomberg Brief.
In tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This is Bloomberg Brief. I'm Manis alongside Danny Berger here in New York. Some fresh optimism on the ceasefire talks coming from Israeli officials. The foreign minister is saying, quote, we've reached a critical point. If matters work out, a large number of hostages will return home then in stages. Everyone, I am more optimistic than I was. This is coming as Hamas said there has been no progress in the talks. Let's bring in our Israel bureau chief, Ethan Bronner, for more. Ethan, which side do we come down on? I mean, where do things stand in terms of this ceasefire? Is it real? Is it perceived? Is it a winning a war of words from the Israeli side? Hamas sound pretty emphatic that there's been no progress.
Yes, well, you've summed it up well. I mean, I don't think we can really know. It's clear that their public postures are quite hardline. The Israeli prime minister has also issued a statement last night saying no matter what, we're going to invade Rafah eventually. And the Hamas officials have said the Israelis have been completely inflexible in what they've offered. So both sides have taken a public posture saying it's the other side's fault. Inside the room in Cairo, there seems to be some flexibility. The idea is that the Americans are pushing very hard for a deal that the Israelis say they can live with, and now they're waiting to see what Hamas says. It'll be a day or two.
From the political side, things in the U.S., so much is riding on Biden being able to usher this in, considering we're entering, or we are in the election year. And on the Israeli side, Netanyahu, of course, has had a lot of criticism. So if a deal is achieved, if there is a ceasefire, what does that mean for the two various politicians?
Look, I think you're right that for President Biden, it's a very important accomplishment, although a lot of the anger at Biden comes from people who are not necessarily eager to see a ceasefire. They're really they have fairly strong views on the illegitimacy of Israel. This is Arab Americans and younger Democrats in places like Michigan. So it's hard to know that it would necessarily help Biden. In terms of Israel, it's a very complex picture because the public and his partners to the center and slightly to the left of him are very eager for a deal, but his partners to the right, on whom he relies to stay in power, are not enthusiastic about a deal. They worry that a deal will mean that there will not be an invasion of Rafah, that Hamas will not be eliminated militarily as they wish to happen. So it's a very complex picture, and I don't know what's going to happen to Prime Minister Netanyahu if a deal emerges.
Well, Prime Minister Netanyahu said last night that there is an actual date for an invasion into Rafah, and then you've got the world leaders, obviously, all various factions over the past number of days, urging Israel not to go into Rafah. So where is that headed?
That's right. Well, we don't know. I mean, I think that, look, part of the importance of the Netanyahu's statement is to say to his own coalition partners, don't worry, don't leave me yet, and to say to Hamas, if you don't go forward with the deal, we're coming to get you. Now, does that mean he will actually go in? I don't think we know. The Israelis pulled out their combat troops from Khan Yunis, the city in the south of Gaza, over Sunday night, Monday. And some people view that as a signal that they're trying to tip their hat to Hamas for a deal. Others say, no, they're just pulling their troops out in order to rest them to go into Rafah afterwards. And I think it's quite possible they themselves are not sure what's going to happen.
All right, Ethan, thank you very much for that update. Ever a fast-moving and complex picture. That is Bloomberg's Ethan Bronner joining us from Tel Aviv. Manis.
Yeah, Danny, let's just check in on some of these commodities because it's certainly worth taking a note. Oil, as I said at the start of the show, we would first drop in 5 sessions yesterday, but we're reasserting ourselves to the upside on the oil market. But iron ore, keep an eye on that, Danny, because there's a real turnaround there. I mean, it's been battered and bruised, down 9%, 10-month low, but it is turning around ever so slightly this morning. So a nice bounce in the iron ore market.
Yeah, and as you point out to me, the biggest two-day jump since 2021. Macquarie says that demand is returning to the seasonal norms.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early...
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Perilously close. We've been dancing around this 152 level in dollar-yen for 3 weeks now, Danny.
Yeah, we're at a 34-year low, so that intervention risk is real and alive. But Steve Englander over at Standard Chartered puts it thusly, that they need to wait until CPI to intervene, because either it's a softer number that helps the yen, or if it's a stronger number, according to Englander, you just want to let the buying happen before you intervene, which would mean they intervene actually around 153.
Well, do you want to hand over? As the Japanese, are they prepared to abscond and hand over all their policy maneuver to the United States of America?
How effective would intervention be with CPI looming, I guess is the question.
Well, here's the point. I mean, they did intervene in 2022, and that was in a reasonable size. The market's actually positioning for a push through the 152 level. We've got an options trade. There's a lovely piece out this morning. What are the options market positioning for? They're positioning for a further push towards 155. And that's where the biggest concentration of options are. But, you know, what was it Ueda said? Monetary policy isn't meant to control FX rates.
Well, the good news about this huge short interest option built around the yen, which at the moment is also its highest since 2007, is that if they do intervene and it is successful slightly pushing up the yen stronger, you get this bout of short covering. So it could actually kind of work in the BOJ's favor.
Well, of course, what we've heard from MUFG, MUFJ was who were with us saying, the risk is that the Bank of Japan is seen as doing one rate rise and done, and that is what leaves dollar-yen flapping in the wind, so to speak, at a lower level. So let's see if they put their money, quite literally, where their mouth is, or whether they're forced into that. There's the crosses for you. Euro-yen fairly flat, but Aussie-yen also on the move there.
Speaking about money, can we talk about this Ivy League story? That it's now going to cost more than $90,000 a year.
Losing.
If you're going to an Ivy League, so if you send your kid there for 4 years, that's more than $350,000.
Now look, not every Ivy League school are you going to pay the full fees. For example, at Penn, there's a $21 billion endowment at Penn. And families who make $75,000 or less, of course, you get some assistance. And then, of course, you've got to look at some of these endowments. They're perhaps not under pressure, but Harvard's certainly seen a bit of a shakedown after the disruption that we saw over the protests on campus. But $90,000, you'd want to make some pretty connected friends for $90,000 a year. But people do.
I would say I don't have kids, but this has me thinking, do I need to start a college fund now?
Just get the Amex side. I'll tell you what, I can give you a spare button from the suit.
Oh, thank you, just what I needed.
Okay, coming up, all contributions to Danny's college fund for the kids, greatly accepted. Keith Lerner, Chief Market Strategist at Truist, joins us shortly.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Brief. I'm Manish Kani in New York.
And I'm Danny Berger. Here's what you need to know.
The 10-year yield eyes 4.5%. Markets settle on just 2 rate cuts for this year, though the former Fed official, James Bullard, sees 3.
Israel signals fresh optimism on ceasefire talks in Gaza, while Hamas claims there's been no progress.
And commodity traders had another blockbuster year, raking in billions for 2023.
Manis, that is the reason that literally commodities are the only sector in European stocks that are doing better this morning. That's where you want to be.
And iron ore has turned it around after being battered and bruised. You're also seeing copper on the up, oil on the up. Go commodities.
Go gold, too. Gold, no sign of quitting. I know you're going to have that in a moment. So, Manis, let me not front run you. Let me show you what these equity markets are doing. It's not a lot. Better than we were about 30 minutes ago. S&P futures, little change, slightly higher. NASDAQ up about 0.1% this morning. We do have a new street high from Wells Fargo, 5,535. I had to think about that one because it's very precise. Saying that the way we think about valuations is now different. It's a very calm market, though. We have CPI later in the week. We also have ECB. So why would you really want to take much risk ahead of that? It also means that volatility is calming down ever so slightly after we finally saw a pickup in protection, in buying of puts, something that has been really absent from this market for some time. Meanwhile, European equities, as I mentioned, Manis, are really languishing this morning, down about 0.1%. Again, it's all about commodities, the only place that you can be successful in this European market this morning.
Yeah, not just there, but also here in the United States of America. You're looking at commodities, you're looking at oil and energy as well. Breaking news headlines coming. This is a story that we've just broken, is that sources familiar with the Bank of Japan believe that we're going to see adjustments in the inflation. These strong wage deals that we've seen come through may well push the Bank of Japan to have to review some of their inflation targets, likely to set 2026 at around 2%. They're considering revising the 2024 CPI forecasts as well. So just keep that in mind. We're on tenterhooks to see whether there is any intervention to come, physical intervention in these markets as well. At 151.80 is where you are. 10-year yields 4.38. Again, the momentum in this bond market, it's almost breathlessly trying to get to 4.5%. Will a hot CPI? We are one step away. It's almost like one breath away from 4.5% on a hotter CPI print. Brent manages to raise itself by 0.3%. Again, what you're seeing here in the oil market is a real concern. Yesterday it was about geopolitics perhaps de-escalating, but there is a fundamental belief that this oil market constricts into the second half of the year. Danny, so of course it is coming down to what the St. Louis Fed President James Bullard spoke yesterday. Of course, we're reflecting on his comments. He's no longer at the Fed, but they are quite prescient. he said it would be justifiable to start the cutting process.
Some people are saying that the next report will lead to core PC being only 2.6% on a 12-month basis. So you're starting to get close enough. I think you have enough data in hand right now to justify the first rate cut, maybe not a whole string of rate cuts, but you could certainly justify the first rate cut now based on the data that they have.
James Bullard there, our next guest, writes this: until the weight of the evidence shifts, our view is bull market rules apply. That is, investors should stick with the primary market uptrend and look to pullbacks as opportunities. It is Keith Lerner, Chief Market Strategist at co-CIO over at Truist. Good to have you with us this morning. So there's Bullard, keen, suggesting that the Fed should get on with it and do 3 rate cuts. You're in full bull mode. Where do you want to take advantage of the drawdowns if and when they come? Good morning.
Yeah, well, great to be with you post the eclipse, right? But I think that's right. You know, I think we have to give the benefit of the doubt to the primary trend, which is up. We also have to remember that we were up 5 straight months. We had a 10% first quarter. Historically, when you see that type of momentum, when you look at 6 to 12 months, the probability of being higher is very positive, but they don't come without pullbacks, right? There's only been 3 years since 1980 where we haven't seen at least a 5% pullback. So listen, I think the main thing, stick with the primary trend. And to your question, you know, as we get pullbacks, where would we look? Well, you know, we like financials, we like industrials. We also still think, even though tech has been pulling back here and consolidating, we think tech leadership likely remains. And part of the reason why we think that is the earning trends for tech still remain stronger than the overall market. And that tends to go hand in hand with the overall tech outperformance. But again, that's also consolidating after really big gains that we saw over the last year.
Oh, Keith, you've set this up perfectly of what I wanted to ask you about. I've been a little bit obsessed about it this morning, I'll be honest. It's Chris Harvey's new street high over at Wells Fargo for a year-end target. Just because it's such a weird number, it's 5,535. He had to outdo the people who had 5,500. I mean, it's just so funny. 35 points more than SocGen to make sure he got that street high. But this is his justification, Keith. He says that in our view, the bull market, AI secular growth story, and index concentration have shifted investors' attention away from traditional valuation measures and towards longer-term growth in discounting metrics. He's essentially saying, Keith, that the normal valuation metrics don't matter to investors anymore, and therefore we're going to get a new high on this S&P 500. What do you make of that?
Well, so I'm hesitant to say valuations don't matter, but I will say when you compare today's valuations versus history, it's not apples to apples. So let me give you an example. The technology sector that we're all talking about in AI, back in 1990, that sector represented about 5 to 6% of the S&P versus about 30% today. And it's actually higher than that because the S&P keeps, changing the index composition. So those companies also have higher profit margins and also typically have a higher valuation metric as well. So I agree that saying that, hey, we're at a 16 or a 17 multiple or 20 multiple and saying this is expensive or cheap is hard. The other thing I'll say in our work, when you look at the starting PE and you try to project 1-year returns, if you do like a scatter plot, right, it's all over the place, meaning the correlations are relatively low. Valuations tend to matter a lot more when you look at from today's starting price, looking at 5 or 10 years later. And that's part of the reason when we look at, so let's say the next 10 years in our long-term capital market assumptions, we're expecting somewhat lower returns than the long term. But in the short term, it's really about sentiment, it's about earnings momentum, and it's about price momentum as well. So that's the way I think about valuations.
I mean, we have had a considerable momentum drive over the past month, and that has brought with it breadth. And you focus on this in terms of what's happening. 11 sectors have risen by more than 5%. We've seen those in energy, we've seen those in financials, and this is the reach for breadth. We're counting down to Citi and a number of the big banks on Friday. Does that breadth continue? And will those sectors, energy and financials, still hold on to those top spots as we endure?
Yeah, I think the more cyclical areas of the market will continue to do well, and part of that is just that we're seeing, if you look globally, so, gold, energy, financials, industrials, the 10-year treasury moving up. The 10-year treasury is moving up because GDP forecasts are moving up. Yeah. We have to remember, coming into this year, U.S. forecast or the consensus was around 1%. We've doubled that, and we're only in April already as well. So I still think that overall cyclical trade still has legs as long as the economy continues to move forward, and I think it will.
But the economy moving forward has also meant that we've dramatically priced out the cuts that are in this market. We went from 158 at the start of the year to now just 60 cuts being priced in, 60 basis points of cuts. And Berenberg's Jonathan Stubbs would say of that, it means that the rates market has moved and the stock market hasn't moved with it. And that is a reason not to chase the stock market rally. To you, does that present a threat, the fact that we've seen yields hit year-to-date highs and stocks have barely budged?
Well, I think you have to say, why have yields moved higher? And again, if you look at it, it's GDP estimates are moving higher as well. The other thing what we look at as yields move higher, we want to say what's happening in the credit markets. Are those becoming wider? And at this point, you look at the credit markets, very well behaved around year-to-date lows. So I think that's actually a positive. One thing we've been on model really for most of this year is that we would prefer, less rate cuts and a stronger economy to an economy that needs a lot more rate cuts as well. So, but to be fair, though, I mean, we've been thinking really since last year about 3 rate cuts. We still think 2 or 3 is on the table, just like Bullard said earlier today. What Bullard said in the past, which I think makes a lot of sense, is saying, hey, if you think neutral is higher, even in, historically, people have thought neutral, the Fed has been around 2.5%. Even if you think it's 3 or 3.5, we're still well above that, so we're still somewhat restrictive. So we still think there's some scope for them to cut rates. I think whether it will be problematic if they don't cut at all, if they kind of take that off the table, that so-called Fed put that people are, looking for, as if the market weakens or the economy weakens, they'll step in. I think that would be the bigger concern. So I think maybe it caps the upside, maybe it creates some gut checks. But overall, if the economy stays somewhat strong and that translates into earnings moving forward, we think the underlying trend still moves higher over the duration of the year. Again, with normal pullbacks, as I mentioned before.
We're counting down to CPI tomorrow, and it does feel as if anything be over and above consensus could cause a sort of a jerk in those yields to 4.5% and maybe even a little bit above that. Do you believe that there are real buyers out there at 4.5%, that there will be no massive acceleration in yields to the upside, even if there is a small dislocation in the CPI tomorrow?
No, listen, I think there could be an overshoot, I mean, in either direction, especially when there's so much focus. It's almost like the CPI report is the new employment report. And if you think about the employment report, regardless of what the number is, there's a knee-jerk reaction. There tends to be an overshoot, and then the market moves on. So, listen, I think there's definitely set up for an overshoot. You could see some type of, like I said, gut check in the overall market. But I would be saying, like, even with that, I mean, on the S&P, around 5,000, there's pretty good support. So, again, I mean, I would be looking to lean into pullbacks as opposed to be selling into them at this point.
Hey, Keith, before we let you go, how did the eclipse look in Atlanta?
I was inside, so I totally missed the eclipse as a whole, and I was making sure I wasn't looking at, from my window looking up. So I missed it. I got to wait to 2044, I'm told now, Keith, for the next one.
Keith, you worked too hard, but you saved your eyes, so that's the good news. Keith, thank you so much for joining us. Keith Lerner of Truist. All right, man, it's coming up. We're going to talk about the blowout quarter for BP. It was a tough 2023, and now they expect strength to continue on. We're going to discuss that next.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You're watching Bloomberg Brief with Danny Berger and Manus Cranny in New York. So Manus, BP ended the year on a high note with a fourth quarter profit that exceeded expectations. And at the same time, they see strong trading performance going forward. Let's get into it with Bloomberg's James Heron, who leads our coverage on European oil. So, a tough 2023 turns into a strong quarter. So what did BP's trading tell us about whether that can continue for the rest of 24?
It suggests that it will continue. They had a pretty good performance trading gas in the final quarter of 2023. That's been maintained in the first quarter, according to the trading update this morning. And their performance in oil trading has improved from a somewhat weak performance in the fourth quarter. And that comes alongside, we've seen in the last couple of days, really quite astonishing profits for the independent oil trading houses, such as Vitol, Trafigura, Mercuria, for 2023. And a lot of price volatility going on. So, yeah, it suggests that the strong trading earnings we've seen from the majors and the trading houses can continue.
Well, it's certainly an astonishing performance at Vitol. This is the world's largest independent oil trader. $13 billion is what they made last year. So those huge earnings, do we know what the alpha was there? Can you imagine the bonus? Can you imagine the bonuses that are going to be paid out there? That's a whole other story. Talk to me about the numbers.
Yeah, the Vitol CEO was speaking this week, and he really put it down to this huge realignment in commodity trade flows that's happened since the invasion of Ukraine. With, Russian oil that used to go to Europe is now going to Asia. Oil that used to go to Asia is going to Europe. And it's not just oil too, it's metals, other commodities. And this is what these trading houses do, right? This is absolutely in their wheelhouse in terms of their expertise. So it's not really surprising that they've seen that huge uptick in profits since 2022 because, there's rich pickings in the market for them.
And James, Manus and I were just discussing this note during the commercial break that Bank of America has out on their price forecast. I mean, they see $3,000 for gold. They see silver, also big rally over the next 12 months. They say the copper crisis is here. Aluminum's also going to rise. I mean, they are talking about this big bullish upswing for commodities. So are the traders looking at that and thinking of the volatility to come and just licking their lips at the moment?
I think so, yes. And, it's gold, it's cocoa as well. Not just the big mainstream energy and metals commodities. So I think, volatility is their business, really. So bullish volatility or bearish volatility, any big moves in prices, they are really well placed to profit from it. So I think, they, as you say, they really must be licking their lips.
Who's not licking their lips at a little bit of volatility? Options traders, anybody out there, it's what makes the daily bread. James, thank you very much. James Heron there, on the commodity. I mean, we've heard this super cycle called a couple of times. Let's pivot to Boeing, Danny. There's the stock pre-market, pretty flat. Boeing and Airbus are both set to post their first quarter deliveries later today, and the analysts are anticipating to see cash woes from Boeing. More bad news. Benny Camel tracks the stories. He is our global editorial lead on aviation. Benny, I mean, it's one thing after another for Boeing. More problems with airplanes this week. But in terms of deliveries, does Boeing lag Airbus? Are there operational issues at Boeing because of investigations? How is it going to play out in deliveries?
So the numbers are out this afternoon around 4 p.m. local time here in Europe, 11 a.m. your time. And what people are really looking out for on the Boeing side is just how bad is it? I think everyone can agree that the numbers won't be good. The question is, will they be breathtakingly bad or will they just not be very good? Boeing has been capped by the regulator in terms of what they can do. They have a limited number of planes they can produce at this point. This is because the regulator wants Boeing to really slow things down, to get that production back in order. And Boeing themselves have said, we are deliberately going slow. So you can expect a fairly low number on that front. And the picture is very different on the Airbus side. We had a story out last week that cited people familiar saying that the numbers are actually fairly good in the first quarter for them. They're not totally out of the woods in terms of supply chain issues. That's still something that's rippling through the industry. But side by side, this is really a story of two diverging companies that historically have moved very much side by side.
And as you're kind of laying out, Benny, we know what the problems are at Boeing, and it's been a picture of perhaps chaos is too strong of a word, but a shakeup. It's been 2 weeks, only 2 weeks, since Boeing announced the CEO's departure. They have new leadership, potential major acquisition, labor negotiations, tougher regulation. Can they convey any sort of stability at this moment in time in this earnings report, in the call with investors?
It's going to be very difficult for them at this point to sort of convey that, as you say, sense of stability. It's somewhat a rudderless company at the moment. Dave Calhoun, the CEO, yes, he's still nominally in place until the end of the year or until they found somebody new. But for all intents and purposes, he's, a lame duck. The people will be looking out for whoever takes over from him. And at this point, the field is wide open. There's a number of names floating around out there. There are people like Culp, who runs GE. There are insiders, there are outsiders. The one theme that's really emerged in terms of who should be next is whoever you speak to says this company needs to go back to basics. They need to go back to being able to produce planes, great planes, really what made the company great. And one of the legacies for Calhoun, rightly or wrongly, will be that he focused too much on the financial side of things. The big number for him was the free cash flow, and it was, let's get to this 10 billion free cash flow now. Most people at Boeing probably won't get out of bed hoping that they'll manage that goal. So really the next person will be somebody who has to rally the troops and get people to, as I said, sort of refocus on the engineering more than on the financial side. So a lot of things that person needs to get right.
And in part, that obsession with the cash flow, profitability, and the bottom line is part of the pay package that he was awarded, a 45% rise to $33 million. And again, another PR. That is the classic PR kind of nightmare, the remuneration being disclosed on the top of everything else. You talk about the profile. Is there anybody that sort of hits the top of that short list at the moment that's free to move to Boeing?
I mean, Larry Culp, as I said, who runs GE. Boeing has traditionally had a very close relationship with GE, and there are pros and cons for him. Nobody's come out at this point and said, I'd like the job, or this is our obvious candidate. There's Pat Shanahan, who used to be at Boeing, who now runs Spirit, their big supplier. There's Stephanie Pope, who's an internal candidate, who until the blowout was seen as the obvious choice. But again, she's somebody with a very financially minded background, and maybe not the person they need right now. So field right open at this point. They do want to move fairly swiftly on this. I don't think it'll take until the end of the year. I think once they do have that person identified, then Calhoun will move aside. But we're talking weeks, maybe even months.
Certainly a brave person that takes the mantle. Benny, thank you so much. Benedict Campbell there from our aviation team. Manus.
Yeah, let's just reflect back on those commodity calls. We have this Bank of America note, you spotted it, and it's certainly worth reflecting. I mean, they're updating copper and aluminium to rise to an average of $12 $3,250 and $3,250 by 2026. But it's the gold and silver, they're looking for $3,000 an ounce. We're already taking out records in these markets as it stands on a daily basis, up 17% for gold since the middle of February.
Yeah, and look, they say it's going to be pushed up by central banks, China investors, and increasingly Western buyers on a confluence of macro factors. Yeah, 3,000 gold, that's quite the round number.
Gold commodities. That's quite a distance, another $700. Coming up, we're going to talk about the rise and the fall of the Trump media stock.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manish Cranny in New York. All right, let's get you set up for your trading day on this Tuesday. Here's what's ahead. We're going to have numbers for small business optimism at 6 a.m. Eastern. And then, as we were just discussing, Boeing's going to report its fourth quarter deliveries after all the drama at the company. That comes at 11 a.m. Eastern. And then the U.S. will sell 3-year notes at 1 p.m. Eastern, Manus. We're also going to get 10-year and 30-year auctions later in the week, too.
Yep, certainly one to chew on if those yields spike a little bit higher. Some stocks to watch. Coinbase and MicroStrategy just both reacting as we saw Bitcoin trade over that $72,000 level, comes back off that. DJT, which is Donald Trump's media company, spiraling from its debut, down 1.25%. Just keep an eye on dollar yen and, of course, those bond markets as well. We may get a revision in some of the inflation numbers, Danny, in dollar yen. There is the little bit of a reaction function.
Yeah, I mean, a little bit. But, I mean, we did go from weakening to strength, so that's something. But Steve Englander says, wait for the CPI for any real intervention. All right, surveillance is going to pick it up from here. This is Bloomberg.
operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
This is happening even with, you can't keep it together, this is happening even with the likes of Mike Ferroli over at JP Morgan shifting their rate cut view from June to July. We've seen this all the way through this year, basically fewer cuts than a later start, and this equity market is still doing okay.
It still seems like, even though we've seen yields at the highest since going back to 2023, people still think it's for the right reasons. It's because growth is coming in strong, and there is this feeling that longer-term inflation will go lower. The test will come this week, and honestly, it will start today. It's exciting today. We get the first of 3 auctions for treasuries that are very interesting. The 3-year auction coming today. Tomorrow, 10-year, 30-year on Thursday. How much will that test how much people are convinced that yields are going to remain within this range?
And even though markets are pushing back these rate cuts expectations, James Bullard to Bloomberg TV overnight saying, why fight the Fed? Listen to what they're saying. They are making a lot of calls that the base case is 3, and he says you should pay attention to that.
Well, let's pay attention to what the New York Fed had to say in its survey yesterday. This quote jumped out to me. The perceived probability of missing a minimum debt payment over the next 3 months rose to 12.9% in March. Now, what is 12.9%? I can tell you, it's the most since the onset of the pandemic. So there are these pockets of stress, Lisa, that are building in the economy away from, I would say, the surface level where things look pretty decent.
They're building, and they've been there, but they haven't gotten that much worse. And we heard that yesterday from Kathy Bostancic, where she said 6 months ago she was really seeing signs of weakness. now less so. It's sort of this persistent sense that, yes, there are pockets of weakness, but it hasn't spread out to become pervasive, which is the reason why it is so difficult to understand this economy, because there are pockets moving at different speeds, and it's hard to get an overall aggregate picture.
Now, be honest, did you practice that in the mirror this morning? FOMO, MOMO, why woe?
If I did, I probably wouldn't have done it, so
Was
no.
that on the spot?
Yeah, that was on the spot, because
Okay,
that's
nice.
essentially what this is. How can you explain it other than FOMO, Momo, and WOWO?
Okay, stocks look like this on the S&P 500, positive by 0.06%, just a little bit of a lift in the equity market. Yesterday, the headline was in the bond market, new highs for the year for 2024 across the curve, the 2-year out to the 30-year. This morning, yields coming back just a little bit. We're down 2 basis points to 439.57. We have got an interesting week ahead, not just auctions, which Bramo's focused on. Lisa, CPI and Fed minutes tomorrow, PPI and jobless claims on Thursday. If you want some Fed speak, New York Fed President John Williams speaking Thursday as well. I think that's noteworthy. Look out for that. Then it's the bank earnings on Friday.
Honestly, to me, this is one of the most fascinating weeks. On one hand, you've got this question of, is inflation under control? And then this other prong that people don't talk about the even possibility of, which is earnings coming out. We got Delta this morning. We've got the bank earnings on Friday. How much do they continue to show the growth that needs to continue for this yield spike to be okay? And I think that really is going to be an interesting test, the sort of two-prong between inflation and really the growth outlook.
Bramo's going to break down Delta a little bit later on this morning.
Yes,
Coming up this hour. He's so excited about that.
Well, it's consumer spending.
I'm with you. Okay. Chris Ferrone of Strategas joining us in just a moment as bond yields ease from highs of the year. Bloomberg's Craig Trudell as Tesla shares jump on robo-taxi hopes. And Shannon Siri-Grind of Wells Fargo with former Fed President Bullard expecting 3 cuts this year. We begin with our top story. Investors looking ahead to CPI and PPI this week as bond yields ease from year-to-date highs. Chris Ferrone of Strategas, a Baird company, writing this. Deteriorating credit conditions can often imply systemic risk, but the bottom rungs of the corporate ladder aren't seeing anything out of step with the higher quality credits, even as 10-year yields have broken through the key 440 level. Chris joins us now for more. Chris, good morning to you.
Great to be here.
How much of a challenge are these high yields to this equity market with the 2-year, 10-year, 30-year in the last 24 hours testing new highs for the year?
I mean, I think it certainly has the potential to disrupt what's been a very tranquil equity environment for the better part of the last 4 or 5 months. I think what we actually want to watch here is not on the surface how equities respond, but does the leadership actually begin to evolve? And maybe if there's one thing that's caught my eye the last couple of weeks as rates have moved back to this 440 range, you've actually seen utilities hang in there. And that's a bit of a change in character from how the group was responding for much of the last 4 or 5 months. So we always start to get maybe a little uncomfortable when the defensives start to actually keep up, even as yields work higher. I think this is very, very subtle at this point. By and large, everywhere I look, there's still this cyclical impulse to leadership. Just the utilities, maybe in the last couple of weeks, is the first little change that we've noted.
I love this because Marko Kolanovic over at JP Morgan thinks that it's actually a sign that they're going to be resilient and you should buy them. So you are hearing people on the other side. And this comes from a conviction that yields are going to move lower, that this is sort of a temporary blip. And this is actually going to be one of the fuels to continue the rally. How much are you starting to push back against that thesis that maybe these yields are here to stay and that's not what this stock market is believing?
Well, that's kind of the camp that I'm in, that yields really won't run away from us here. And certainly 440, 450 may challenge that view. But when you look at the macro tone and look at the strength in gold, if bond yields were going to run away from us, I don't think gold would be this persistent. I think yesterday was interesting that you had these real estate names actually act very well despite the pop higher in yields, and the banks are acting fine through all of this. So if we were going to lose yields to 5 or 550, I think the leadership fabric of the market might look different. We just don't see it yet. And Lisa, I might just add, these global bond yields have not moved to the same extent that the U.S. yields have. UK 10s are still below the 200-day. I mean, UK 2s are closer to their lows than their highs. German 10s have not run away. So a little bit of a different picture globally as well.
The confusion aspect is really interesting. And Bank of America, the derivative strategist, came out and they said, this is a pretty confusing rally, particularly in commodities. Probably better to rent it than to own it. How much are you seeing that more broadly? People want to rent. They don't want to own anything because they don't understand the thesis behind it.
I have the luxury of not caring about what the thesis is behind it, right? We look at price action and momentum.
Well, good for you. We have to discuss it every day.
This move in commodities, I think, is the real deal, though. I mean, these breakouts in copper, this has been years in the making. This breakout in gold has been years in the making. Are they short-term overbought? Of course they are.
Silver too, massive move.
Yeah, the devil's metal. I've lost more money trying to play silver in my career, so we'll leave that one on the side. But when you look at this just massive breakout, not just in copper, but the related equities, look at Antofagasta in London, look at Freeport here, or Southern Copper. Some of these Chinese copper and aluminum names have really started to move as well. There is something going on here. And I think it's also replicated. You know, we talk about this cyclical impulse to leadership. Look at the European auto stocks. I mean, look at the huge bases that BMW and Mercedes are breaking out of. So there is something happening globally. Maybe China's the impulse for all of this, but this move in copper is the real deal.
Well, can we get to the something? Because you've got the move in base metals, you've also got the move in precious metals. What do you think is developing between the two?
So the traditional rule would always be look at the industrial metals versus the precious metals, and when industrial metals are outperforming, the economy is generally on good footing. In reality, a lot of those relationships have not worked since COVID. So I'm a little reluctant to make any kind of broad proclamation about what that pair means today. What I think is notable is if gold was sending an ominous message that, hey, something really sinister is out there, I would expect credit to be worse, and I would expect copper to be breaking down. And neither of those two things are happening right now.
Is the ingredient just inflation? Is that the catalyst for this?
You know, but inflation expectations really haven't moved a whole heck of a lot. So, you know, again, I go back to what is the leadership message of the equity market? Aside from this improvement we've seen in energy and materials, it really has yet to be at the major detriment of the things you would expect to get hurt if inflation was really returning in some long-standing way. The discretionary stocks are generally still okay. That's true globally. So there's a point where too much energy or too much materials can start to work against the equity market. I'm not convinced we're quite at that point yet.
So we're working this out in real time with you in this conversation because I certainly don't know either. But listening to you, it sounds like you think this might be a reflection of the extension of the cycle and not maybe a list of things to end it. Would you include crude in that as well?
Yeah, I mean, I think back to late 21, it was about $90, $92 crude where you really began to work against equities. I think that's when roughly, call it November of 21, when discretionary really started to falter, when crude pushed through 90. So there's certainly some importance to that $90 level on oil. We'll see if we get there or not. It's an election year. I would not be surprised if more tricks are pulled out of the bag here over the next 6 months. But I think the bigger picture, where are we in the cycle? If this was end of cycle, I think the conditions leading up to this moment would look different. Credit would look different. The leadership would be far more defensive. I think the internals in the equity market would be deteriorating. None of that means you can't have a correction or a pause here. There are parts of this market that look fatigued. You see a little bit of it in tech, but I think by and large, are the conditions in place for a big problem here? Probably not.
I love that you, like almost everyone who comes on this show, basically says that any pullback is a reason to buy, and that any more material downturn isn't the beginning of the end of something, but something that should be an opportunity. Does it worry you that we have gotten none such opportunities and that so many people want to buy, that the dips that we have gotten have been some of the smallest that we've seen over the past, say, almost a year, going back to 1928?
I think, if anything, in my world, it's a testament to the power of trend following, right? This has been an uptrend for the better part of the last 14 or 15 months. I think the inability for the consensus to put some neat narrative or tight narrative around it has actually prohibited people from participating or playing to the extent that they probably should have. We fell victim to that in the first half of last year until finally, you know, the leadership and the conditions were just so strong. Like, you have to play in trends that look like this. So I still think that's the base case here.
So I like to look for what we might be missing.
Yeah.
And some people might say when you have such a strong trend following kind of momentum, it can lead you to places that are pretty lofty and bubblicious. How far are we from that? How far are we from momentum getting so divorced from having to have any narrative just because so many people have missed out and it seems like there isn't anything to torpedo it right now?
I mean, you can get a pretty easy technical target of 6,100 on the S&P. I mean, that would be the projection from the breakout in the last half of 2023 versus the low earlier in 22. That projects to about 6,100. So mathematically, I can get you there. Whether we will or whether we not, we'll see in time. But what I think is most important, you know, what ends trends? Trends decay from the inside first. You see the percent of stocks above the 200-day moving average start to roll over. You see the new high lists begin to evaporate, none of which have happened to this point yet. So I think the question that we're always grappling with is, when do you start to bet against a trend? When is there enough information out there to bet against a trend? I'm not sure we're at that point yet.
Okay, appearance fee. You ready? I'm going to pay it. the launch of the Strategas Macro Momentum ETF. Congratulations.
Thank you.
Talk to us about it. What is it?
Super excited. Ticker's SAMM for Macro Momentum. It's really taking what we've done the last 20 years in our research and putting it out in an investable product. And our goal and our work has always been to seek momentum wherever and whenever it's found. And I think this market right now is a very good example of that, how the momentum impetus is shifting from maybe tech to something like copper or materials or energy. And that's what we're really trying to catch, those early inflections, often before some elegant macro narrative has formed.
You're looking at me. None of mine are elegant.
If I buy that this morning, then what am I buying? What am I exposed to?
We're getting a lot of materials, a lot of copper stocks, a lot of energy, a lot of financials, which, John, as you know, have acted great through all this, despite this story that they shouldn't be working as bond yields have moved higher. There's some real estate names in there, kind of under the same guise. Consumer discretionary and industrials generally act pretty good too.
Well, congrats to you and the team.
Thank you.
Appreciate it. Great to see you. Thank you, sir. Chris Ferrone there of Strategas. Your equity market at the moment positive by 0.1% on the S&P 500. Let's get you an update on stories elsewhere. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. JP Morgan's Marko Kolanovic has finally found something to buy. He's urging his clients to buy utilities and real estate, the two worst performing groups in the S&P so far this year. As many people know, he's been warning since late last year that investors should stay away from equities broadly, a call which has not exactly gone right. Kolanovic says that utility weakness has probably gone too far, and real estate is, quote, of interest too, even with its bond yield correlation. Blackstone is said to be nearing a deal to take cosmetics company L'Occitane private. Bloomberg has learned that the private equity firm may team up with the cosmetic giant's billionaire owner for the buyout. Trading in the company in Hong Kong was suspended pending an announcement. The company has a market value of $5.6 billion, with its chairman owning more than 70%. And the UConn Huskies are back atop the college basketball world. UConn defeated Purdue in the NCAA National Championship game. The score was 75-60. It's now their second straight title win. The Huskies cap off a dominant season in which they only lost 3 games. They also become the first team to win back-to-back titles since 2007. Now UConn boasts a 6-0 record in national championship games going back to 1999. That's your Bloomberg brief, John.
Congratulations to them. Danny, thank you. Question for everybody at home. Have you ever seen anyone in a L'Occitane in Manhattan? You ever seen anyone? I've never seen anyone in the store.
They're pretty.
I play this game all the time.
Yeah.
I walk past them. I say, is anyone going to be in there this time around? They aren't. Them and the Nut Factory. Okay. Those stores exist.
Okay, I
never see anyone in there.
I've gone in the Nut Factory.
You've been in?
I've been in.
Was anyone else in there when you went in?
I don't want to, no comment. And L'Occitane, I think I was, but it wasn't in New York.
I've never seen anyone in these stores.
It's true, it's true. I mean, I guess that it's not really a perusing kind of place, and it's very expensive, and maybe, you know.
I get the feeling AMH shops there, but...
Once in a while.
Once in a while? Okay. Up next on this program, Tesla's robo-taxi pivot.
I read recently that Tesla has decided not to pursue their Model 2, the low-end car, because they don't think that they can compete with the low-end Chinese cars. I think it's a shame. They might want to rethink that.
That conversation up next, live from New York City this morning. Good morning.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Earnings season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
Not a single message from anyone who's been in L'Occitane. No one. Lots of people agreeing.
Yes.
No one's been in.
Okay. What's your theory, John? Why don't you think people go in there?
I don't have a theory. There's no theory to share this morning. I'm just saying. Don't see people in there.
Well, you know,
I think companies, airlines buy in bulk. This is like the quintessential moisturizer you get in a gift basket.
To me, they just need to cater to the tween crowd. Cater to a bunch of masks that they don't need because they've got perfect skin, and have them in with their rich moms, and they're all good.
What airline are you going on to get that stuff? They're giving
I mean,
you
there's
that
even
stuff
better.
on airlines.
Qatar Airways, you get Diptyque. It's amazing.
Really? In little bags? Nice. Okay. Equities on the S&P 500. I've got to change airlines. Equities look like this. We're positive 0.1%. Yields are a little bit lower by 3 basis points, 438.97. In the commodity market, 86.67 on crude. Bit of a bounce here by 1/3 of 1%. Under surveillance this morning, Tesla's robo-taxi pivot.
I read recently that Tesla has decided not to pursue their Model 2, the low-end car, because they don't think that they can compete with the low-end Chinese cars. I think it's a shame. They might want to rethink that. It's a new technology, and it's difficult to drive the technology price down. Tesla needs to be focused on cost. Tesla needs to be focused on cost instead of focusing on technology for the sake of technology.
It's the latest this morning. The Tesla CEO, Elon Musk, pushing back against reports from Reuters that the company is scrapping its low-cost Model 2 vehicle as it faces tough competition from Chinese rivals. Musk denied those reports on X, instead announcing a planned reveal of robo-taxis on August 8th. Bloomberg's Craig Trudell joins us now for more. Now, Craig, we've had promises of this developing, and we've had promises repeatedly over this developing. Craig, is this the real deal later this year?
Color me skeptical. I do think that they will show something. I think it'll be a prototype. And as we wrote yesterday, it's often the case that,